Very good morning, my dear future chartered accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Yes? Okay, thank you. So today we are going to start a new chapter, derivatives. I should say this is only for strong-hearted people. If any people have weak heart or people are who are not confident, should not watch this disclaimer. Anyway, that's the opinion most people have. Let us try to break that opinion. Let's try to understand the derivative in a simple manner but yet effective manner. Hope all of you are ready. Let's start with a basic thing. There is one underlying thing I have to tell you. I'll be repeating so many times. Derivative means it's a contract. That's all. Derivative is a contract. Rest, I will discuss everything subsequently. Let's try to understand the situation with the help of cricket. It's not really a betting as such. You should not come to an opinion derivatives are betting, but you need to have two opinions. So I'm taking betting as an example. So please don't think I'm advocating betting or something. I'm just trying to make you understand how two different views can create different positions. Okay? In a cricket match, there are two persons. First person is having opinion Sachin Tendulkar will score a century. I'm from that era. You like Virat Kohli, you change it accordingly. Another person says, no, Sachin, don't score century. And they have a amount betting. I should say it's not a betting. They have a position. Let's say that 20 rupees. Okay. Now, if Sachin scores a century, who wins? The first person wins. Therefore, he gets 20 rupees. If he does not score century, then what will happen? Other persons gets 20 rupees and this person will lose 20 rupees. You understood? Very simple concept. You win, you get 20. You lose 20. This is one simple situation. Okay. Let's try to change slightly. Same two persons betting that Sachin will score a century. Other person that will does not. But the thing is slightly different here. What is that? You get rupee 1 for every score above 100. You get rupee 1 for every score above 100. So it's not just a tossing plus 20 minus 20. It is not just about two numbers. Some calculations will come. In derivative also it will come. So some people will have to understand. So I'm making you understand through this. Don't write anything. Just sit, listen, enjoy, and if you have any questions, get it clarified. So, understood the position? It's not just about scoring a century. He is telling he's not only going to century, how much ever he scores above 100, for every 1 rupee, extra 100 runs, I get 1 rupee. So, if Sachin scores 90, that means he is falling short of century by how much? 10. So he's going to lose 10. Obviously, other person will gain 10. Okay, if he scores 100, that means that's what he has done. So you get 0, other person also gets 0. If he scores 105, he has scored 5 rupee more than 100. That is what is, you get 5 rupees. Other person will lose 5 rupees. If he scores 120, he scores 20 above, so you get 20. Other person will lose 20. 130, 30, other person will lose 30. Understood the situations. Typically, this is called as a future contract. One person is having one opinion, other person is having an opposite opinion. Let's look at one more situation. One person is betting that Sachin will score a century, other person telling no, Sachin won't score a century, and he says, I will pay 20 rupees and for every one run above 100. For every one run above 100. If he scores 90, he will not lose 10 here, unlike the previous one, because he already paid 20 rupees in advance. That means if he loses only 20 rupees, not beyond that. That's it. He did not score century, 20 rupees, you lose. Other person will gain full 20 rupees. If Sachin scores exactly 100, then whatever you paid 20 rupees gone. That is not going to be recovered. Same 20 rupees profit, 20 rupees loss. If he scores 105, now try to think what will happen. He did score what you were expecting him to do, and he did score above 100. How much above 100? 5 rupees. But you have already paid 20 rupees, therefore 15 rupees is your loss. That 15 rupee is the gain for other person. If he scores 120 rupees, then he scored 20 excess, so you get 20 rupees. You already pay 20 rupees, so you get a break even actually, 0 profit, 0 loss. And 130 scores, then you get 10 rupees for 20 rupee invested. So it's like a 50% profit. Other person lose 10 rupees. Okay. Hope you understood the basic mechanism. Its derivative is all about two people having different opinions. Because two positions are there, many people also say, oh, derivative is about betting. Many people do use it for betting, or they call it a speculation. But I would say the purpose is not only that. We have other purposes, we are going to see that. But as an example, I started with that. So what is essentially a derivative? Let me give one more simple example. Let's say you have a wallet or a purse which contains, let's say, 5 2000 rupee notes. 5 2000 rupee notes. What does it value? You say 10,000, right? But the same wallet contains just one 2000 rupee note. Then you say, oh, value of the wallet is 2000 rupees. That is the nature of derivatives. A derivative is a dependent instrument. Dependent on what? Dependent on underlying variable. So whenever we say derivative, there has to be an instrument and there has to be an underlying variable. For example, you have a gift coupon. The gift coupon says 10% off on computer you buy. Computer price is 50,000. So 10% off means the value of gift coupon is 5,000. If the price becomes 60,000, what is the value of gift coupon? 10% off means 6,000. If the value of computer becomes 40,000, price of the computer, 10% off, the value of the gift coupon becomes 4,000. You understand? As and when the value of underlying asset is fluctuating, the derivative value is also fluctuating. That is the nature of derivatives. So essentially, I will say derivative consists of, or derivative has got three main characteristics. Three main characteristics. Important. Just give me 1 second. Charts are there, but I would like to. Okay, let's go for chart only. Three conditions are there. Understand very clearly, very simple. They will not ask in exam, but this is your foundation of the entire chapter. And this chapter, what you read, what you understand, will spill over other chapters like Forex, interest rate management, and so on. So it has got a very important application. Learn it carefully. And people who say stock markets, who do trade more than stock, they do derivatives only. Traders, I'm telling, not about investors. Okay. So first thing, derivative is a dependency, I told you. So there are two things I told you. One is underlying asset, other is a derivative instrument. That is what value of instrument changes, value of derivative changes with respect to the changes in underlying variable. For example, if it is USD INR futures, USD INR futures, and that means uh, as and when USD INR changes, the future also will change. Hope you understand. This is like, even you can follow two people. If one person goes, other person also follow that person. You understand? You would have seen a lot of these kinds in your workplace, college and all. Or let's say boy and girl. If one person goes, other person simply follows. We call them as derivatives. Dependents, basically. Initial investment should be zero or minimal as compared to buy underlying. I'll give an example little later. But this is I would like to focus more. Settled at a future date, which means this is a contract. This is a contract. Means when you buy stocks, the spot market, you're buying the shares today. You're paying the money, you're getting the shares. It's called as cash and carry. You make the payment, you get the share. That is spot market. But derivative means it's a contract. What is contract? You just come to an agreement. That agreement will be settled later. So derivative will always have a settlement date. To be specific, it's called as expiry date. In India, it is month end. Last Thursday of every month for stocks is the expiry date. And for Nifty, Bank Nifty, and one more Nifty, it is Nifty banking services are there. Service financial service Nifty is there. So for these three, we have weekly expiry. Anyway, so for the stock, we have monthly expiry, and for the index, we have weekly expiry. Derivatives will have a settlement date that is fixed in advance. On that day, settlement has to happen. On that day, settlement has to happen. I hope you got the point. Examples on derivatives, maybe future contract, forward contract, options contract, we'll discuss all of them. Underlying can be share price, stock index, commodities, foreign currency, interest rates, and so on. Okay, the last two part is just an example. What is most important? Derivative means it's a contract and the value of the derivative instrument changes with respect to the underlying instrument. The underlying instrument must be mentioned in the contract, and initial investment should be zero or minimal as compared to buying. What do you mean by that? I'll give a simple example. I told you derivative is a contract. Suppose the contract says it's about buying 50 shares of Infosys. The contract says buying 50 shares of Infosys. So derivative is about what? Buying 50 shares of Infosys. If I actually buy 50 shares of Infosys, those two costs should be same. Understanding? Should not be same. The cost of buying 50 shares should be different from the cost of entering into contract which buys 50 shares. Shall I repeat once more? The cost of buying 50 shares is different from, should be different from the cost of entering into a contract which buys 50 Infosys shares. I'm not talking about 50 Infosys shares. To enter into contract, maybe futures, maybe options, that contract cost. So for signing a contract, there will be a cost. Yes, that is derivative cost. We are going to discuss that. To enter into an agreement, to enter into a contract, what price you pay should be definitely lesser than the value of contract itself. And that is what the initial investment should be zero. Either it should be zero or it should be minimal as compared to the value of underlying. So if I say, if I value the derivative instrument, for example, the gift coupon example I gave you, right? See, the cost of the asset is computer 50,000, 60,000, 40,000. What is the value of derivative? 5,000, 6,000, 4,000. Minimal, right? What if somebody says the value of this gift coupon is, if somebody is selling at 45,000, then if you purchase the asset 50,000, gift coupon 45,000, gift coupon is not really called as derivatives. I'm not sure. This is a very important concept. Even you learn in FR, financial instruments, to classify whether it is derivative or not. Okay, so this is the basics I wanted to you to make understand about derivatives, and then we'll have some more introduction. Uh, just make sure that you have understand till here. Any questions? Okay. Let me just give a three markets comparison quickly for your understanding. Maybe it will come later also. Okay. Basically, three types of markets that you have to understand from a exam point of view, practical also. Many more are there, but to begin with. Okay. So we have something called as spot market, and we have derivative market, derivative segment. Let's say stock market. Even currency also we have spot and derivatives. Let's talk about stock. Spot market, we say cash and carry. Means you make the payment, you get the share. As simple as that. In derivative, we have broadly two types. One is futures and the other is options. I'll discuss more. Many are there, even forwards are there, swaps are there. We'll discuss more, but these are the two main important aspects. In fact, practically, options only are 95% of the volume as compared to the derivative transaction. So, practically, options are to be learned more. You have option trading strategies, option trading courses, and all. Futures have not that complicated, but from exam point of view for you people, you have to understand both because questions comes equally from both. So let's give equal importance. Okay, basically what is future? Future means you fix a price, you agree upon a price, you agree upon a price, that is called as future price. Okay, and in options also you agree upon a price, and that's called as strike price. Strike price. Then what is the difference? Broadly, in futures, agreement you have entered into, it is compulsory that you have to execute. You don't have any choice. But in options, you agree upon a strike price, right? Whether you will execute the agreement or not depends on the market price on the settlement date. In the sense, if it is beneficial to you, you will exercise. Otherwise, you say, I don't want this. You understood? In futures, you don't have a choice. It is a compulsory settlement. Whereas in options, you have a choice. It is going to be, I mean, you can execute the contract only if it is in your favor. If it is not in your favor, you are going to say, cancel the options. Sir, how is it possible? Does it make sense? Does it make justice? All those things we'll discuss later. Okay, so spot market is immediate cash and carry. You buy, you sell, that's all. Future, you enter into a contract which will be settled later, which is a compulsory settlement. Options, you have a choice. To give an example, I'll try to give this on a lighter note. Please don't take me personally. Just for example, I'm giving you this. Spot market is like a swayamvar. You understand what is like a swayamvar? On that day, you are going to select. We don't know what kind of person you get. Maybe the person you like, or maybe the person you don't like that day. Cash and carry. I mean, cash and carry, I don't know how do you understand. But that day is your day. You purchase and you are fixed. That's all. Later, market goes up, profit comes down, loss. You can't do anything. Futures are you're signing into a contract because you see in Swayamvar I told you there are many people you're going to select one person. Sorry, you have to select one person. Who select boys or girl? I'm not going to talk about it. I don't want to be gender specific here. Just the concept I'm discussing. So spot market on that day we don't know who comes or somebody may come, somebody may not come also. If nobody comes, you are at a deep problem. Basically, nobody is there for you. So in that sense, what do you do? I don't want to keep my things open. I don't want to be waiting for that day. Today itself, I'll sign a contract. What is that called as? Engagement. Essentially, engagement is a contract which will be settled at a future date, maybe for a consideration. And on the day of settlement, you have to execute. You don't have any choice. If somebody else may walk here and there, walking here, there, you also might have expressed. You might have felt, oh, I should have waited. You could get that feeling, no? I should have waited. Maybe I would have got a better alternative. Or you say, no, no, I think I did a better thing. Looking at the alternatives, this was better. Opportunity cost, opportunity gain. All are notional. What about options? Futures are like engagement, a contract is signed. Okay, what about options? Options are like living in relationships. You are into a contract, but you always have a choice, which can be cancelled at any point in time. But of course, that comes with a price. Anyway, just to give on a later note, I told you, don't take it very seriously. So, spot market we have, future market we have, options market. We are going to learn many more like a forward market, interest rate swaps, and so on. We are going to discuss. Broadly, these two are the common derivatives. If you understand these two, others are very similar to this. These are the two important varieties, major varieties, substantial varieties. I hope you have taken down this simple chart. We have to discuss one by one. We'll discuss a little bit later. Okay. Before we go further to derivatives, few basic points I would like to understand. I would like to discuss the objectives of derivatives. As I told you, many people have the opinion, oh, derivatives means betting. In a sense, it is true, but I don't want to really call it as betting. But in a sense, it is like speculation. That is one objective. But more importantly, a derivative can also be used for hedging purpose. A derivative can also be used for finding arbitrage opportunities. So before we understand, we'll solve the problems also. Futures speculation, futures hedging, futures arbitrage. We are going to do problems on all the three varieties, all the three objectives. But first we'll understand individual one by one. What is speculation? Okay, so you can also give the heading speculation, speculation, and you can simple, will not write too many sentences. Speculation, it means basically uncertain profit, uncertainty. In spot market also speculation is there. In life also speculation is there. We know IPL may happen, may not happen. Tomorrow rain may come, may not come. We are full of uncertainties. Okay. Speculation. In a sense, people understand it like a betting. This is why many people believe stock market means betting, uh, derivative means betting. If you take a lottery, you win or you lose. So you say that one person's expense is other person's income. So lottery is gambling. Perfectly correct. Now, can I say like this? In class, your expense is my income. Therefore, taking class is also lottery. I mean, it's also gambling. Can we say that? You purchase vegetables. For you, it is an expense. For him, it is an income. Oh, purchasing vegetables is also a gambling? No. Every uncertainty is not gambling. Be very clear about it. Gambling is uncertainty, but every uncertainty is not gambling. So, speculation in a way is similar to betting. What is common to betting or what is similarities to betting? Similarity with betting is one person's profits is others' loss. Yes, that is true. If you use derivative for speculation purpose, or it's also called as zero sum game. Zero sum game. In the sense, one person's profit. I mean, when you consider everybody, that is, if two peoples are there, if you add everything, that means overall it will be zero. It's basically moving from one person to other person. And that is why you see GST will not be charged. If you sell the shares or if you enter into speculation transaction, if you make a profit, they will not charge you GST on that. When you sell the shares, GST will not be charged. Of course, STT will be charged. That's different tax. But GST will not be charged because there is no value addition, no products, no service. But brokerage, they charge GST because broker is giving you service. But by selling the shares, by buying the shares, it is moving from one person to another person. Therefore, there is no GST. Even this will not be counted as part of GDP because there is no asset being created. So, in that sense, yes, it is a betting. But what is not similar to betting is it is different because there are underlying variables. There are so much of analysis involved. There are underlying variables. There are analysis. And there are other situations also will be there. So, for example, when you say derivative, Infosys options, okay, what is the strike price? Let us analyze what is likely to happen, what is the probability. So, a lot of uh, decision making is there. I will say decision making. See, for example, you travel between from home to office. How much time it takes? How do you know the future? We don't know the future, right? It might take 1 hour also. It might take 30 minutes also. But what do you do? On an average, it will take around 40 minutes. See, based on the average, you are making a decision. Yes. So if that average on that day does not hold good, yes, you go to office late. On that day, if it happens to be earlier, okay, you go to the office even more earlier. So are you betting on that? So every uncertainty is not a betting. So uncertainty is the word we use it for speculation. So uncertainty, we are keeping the things open, uncover. That is called as speculation. We are just taking a chance. Let me tell you, are you speculating on CA exam question paper? What do you think? Do you speculate on CA exam question paper? Okay, you do ABC analysis and all. Okay, some people know, say no. Forget about all those things. No ABC analysis. I'm not asking that. Do you know the question paper? What questions will come in exam with 100% certainty? Definitely no. That means you're speculating. Understand? Somehow the word speculation, people always associate with betting. Somehow they do it. It's not true. Speculation is a word, we should use it for uncertainty. So, speculation is there in every walk of life because future is uncertain. We don't know what questions will come in the exam. We have to prepare. So we have a speculation, we have a uncertainty, we have a risk. So we try to manage that risk by taking classes. I'm going to come to the next heading. I'm spending more time on the basics. It's okay even if I spend almost one class on the basics, but I would like to make sure that your foundation derivative is very strong. So for you to understand the derivative in the right manner, these words need to be understood clearly. These are not definitions. That's because SFM don't have definitions. So it has more of common sense and more of uh, commonly used phrases. Because you are not used to it in practical life about SFM, because you are more into articleship, into taxes, accounts, audit, and so on. So I'm trying to spend some time on these terminologies. So speculation includes betting also, but it is not about betting. People can use anything for betting in the sense, right? On the cricket match, people say betting. So can we say ban cricket? Oh, people are betting. No, cricket cannot be banned. Betting, okay. And why betting is banned, first of all? Why it is not legal in some cases? The reason is people will exploit. That's the main reason. One person can exploit another, or the one person can cheat. That is why betting is illegal. Anyway, let's not talk about that much. Speculation just means that we don't know the future. Speculation exists in every walk of life, even in stock market, in spot market also, in derivative market also. Spot market, you buy the Infosys shares today, thinking that it will go up. Yes, if it goes up, you make profit. It does not go up, you can wait some more time, but you may make loss later. Okay, I hope the word speculation does not mean betting. The speculation is about a situation of uncertainty. You don't have to write too many sentences. A bullet points like this, one or two is sufficient. Hope you are clear about the first objective. Speculation is done. Let's come to the second most important word that you have to consider is hedging. Basically, hedging is for risk management. Okay. Now, when you enter into a stock market, when you enter into a spot market, when you enter into a derivative segment, you have a risk. Because you don't know the future, you have a risk. Now, how do you reduce the risk? Can we avoid the risk? Most often not. Maybe in exceptional situation, maybe theoretically it can be, practically it cannot be. So we cannot avoid risk, we can manage risk. See, tomorrow rain may come, but you have to go outside. Rain may come, may not come. There is a uncertainty. If rain comes, it's going to be a problem. You have a risk. You cannot stop that. You cannot manage. You can manage it. How you manage? You can carry umbrella. You can do all those whatever equipments you can. If you want to protect the car, you can. It is or if you want to protect your crops, or you want to protect your shop, you can use plastic covers, car covers. There is a risk, there is an uncertainty being created, but if you keep it open as it is, it's going to be a problem. So you take a position to manage that. Various example can be given. Common example, there is a sentence, hedging. I would say, have a backup before breakup. Don't ask me to repeat. If you understood, great. If not, even more great. Yes, one more typical example, insurance. A typical example is insurance. Definitely right. Car insurance, health insurance. You're worried that things might be getting affected, you take an insurance policy for that. You pay premium. You cover the risk. Insurance actually is all about risk. More than the risk management you learn, insurance subject is more about risk. So managing that is called as hedging. In derivatives also, we can use, actually derivatives are developed for the purpose of hedging only, but now it has turned into various other purposes. You also do hedging. Sometimes hedging can backfire also. You are doing CA, that is a risk. So what do? Let me do BCom also as a safety purpose. Hedging you are doing. Basically, you have a risk in one hand, and to manage the risk, you take another position. So what is the basic difference between speculation? In speculation, you're only having one position. You're having only one position. Whereas in hedging, you're having one position that is creating the risk, and another one which is managing the risk. So two instruments, and that is called as hedging. So it's a risk management technique. Derivatives can be used as a hedging instruments. You are going to learn in FR also, hedging items which create the risk, hedging instruments which will offset the risk, and that's where you will have hedge accounting in FR. Okay, that's about speculation and hedging. Let's move further. Third one is arbitrage. Arbitrage, after these softwares came into picture, technology came into picture, practically arbitrage does not exist. Very momentary, you can say, but not really exist in a large manner. But in examination, definitely they will ask arbitrage techniques, so you have to understand. What is the arbitrage? It's the process of taking the advantage of imperfect market price. Buy at a cheaper price, sell at a higher price. I'll explain this. Very simple but logical. You can use it in many places of your life also. Okay, let's say there are two markets. There are two markets, A and B, next to each other. Or there are two shops. Let's say two shops. Two shops next to each other. They are selling some vegetables. A is selling the vegetable at 100 rupee per kg. B is selling the vegetable at 90 rupee per kg. Remember, for the same quality, maybe supplier is same for both the shops. Supplier is same in both the shops. So all other things remaining same. The quality of the product is same. The packaging is same. The service of the two people are same. All other things remaining same. If one person selling at 100 rupees, if other person's selling at 90, do you think a person at 100 rupees will be able to sell? Logically speaking, lack of information is different issue. A giving a better service is different issue. Customer loyalty, different issue. I'm just talking about all other things remaining same. Only the price is different. Obviously, no. People will go and buy at 90 rupees. Okay. Now let's come to NSE websites, BSE market. Both are stock exchanges. Essentially, they are markets for you to buy and sell. Now, in NSE, if the share price is 1020 rupees, can BSE share price be 1000 rupees? If that is the case, what will happen? I will go and buy in BSE, right? Why will I buy in NSE? Because shares quality is same. What shares, what quality you get? Same only. Shares you get. It will come to demat account. That is arbitrage. You have two markets offering you the same thing, same underlying assets. Two markets offering you the same thing, same underlying asset, should have same price. If the price is different, imperfect market price, if the price is different, quality remaining same. If the price is different, then over a period of time, there will be a balance, because in buyer's thing, what will happen when the price is less? more and more people go and buy there. So when lot of demand comes, price increase. And this person who cannot sell because price is high, he has to reduce the price for him to sell. So there will be a balance. So basically, arbitrage says there has to be one single price between two markets. Of course, if it is slightly different, the transportation cost should take care of it. So difference can be to that extent, not beyond that. Otherwise, what happens if a person can buy in one place and sell in another place? So if there are two markets offering same quality products, if one price is less, other price is more, there will be a balance over a period of time due to demand and supply. One way of understanding. Another way is people can look for arbitrage opportunity. What is arbitrage opportunity? You buy at a cheaper price, sell at a higher price, anyway same quality. So you can make easy profit, guarantee profit, certain profit. So if there is arbitrage opportunity, that is if the price is not perfect. So if arbitrage, if opportunity is there, if opportunity exists, or if opportunity does not exist, that means there is perfect pricing. Price is perfect. Price is same. If or we'll say fair price is fair. If opportunity does not exist, if opportunity does not exist, sorry, if opportunity exists, if opportunity exists, meaning price is different, price different, then you can make arbitrage profit. Opportunity exists, which means you can make riskless profit. Riskless profit. Without any risk, you can make a profit. And you know that amount in advance also. How you can make riskless profit? We have to make arbitrage strategies. We'll discuss that in uh, derivatives. There are also funds. They are called as arbitrage funds. I'll tell you how these arbitrage funds also can make it. So arbitrage basically means it can give you riskless profit because of imperfection in the market price. You buy in one place, you sell in another place. Arbitrage. You can make riskless profit. We'll discuss many more as well. Okay. So I hope you are clear about the three objectives we discussed, my dear friends. Speculation, hedging, arbitrage. Any questions you want to ask? I'll wait for 1 minute. These three objectives of instruments, you have to be very clear. While solving problems also, you have to understand, am I solving a speculation problem? Am I solving a hedging problem? Am I solving a arbitrage problems from exam point of view? And for all of those things, I'm going to give a tabular format. I'm sure you'll be able to solve the problem easily in exams. Okay, so hope it is clear. The objectives, we have a speculation, hedging, arbitrage. Very good. Next, some basic assumptions. I would have discussed in the basics class also. We always start with zero position. What do you mean by zero position? You will have cost if it is own source also, or if it is borrowed funds also. If it is own source, you have an opportunity cost, expectation you want to make profit. And if it is borrowed funds, you have to pay interest. So own funds also will have a cost. Borrowed funds also will have a cost, because we are assuming we are at zero position. Whichever may be the source, both has cost. Okay. Settlement types. This is important. We have delivery basis settlement, net based settlement, very, very important, especially in derivatives. I'll discuss that. Then positions or view is a long position, short position. I'll discuss that. Okay. First, this basic assumption I talked about it already. Let's focus on settlement types, delivery basis and net basis. Very, very important. And let me tell you, ultimate effect will be same only. Ultimate effect is same, but still settlement can be of two types. I'll give you a very simple example. Very simple example. Let's say you enter into an agreement to buy some vegetable, some product. I don't know which, some X product. Buy a product at rupees, let's say 100 per kg. Simple example. You entered into an agreement. It can be agreement, can be anything. Manufacturer enter into agreement with some supplier, or you enter into agreement with some customer, something. You entered into a contract to buy at 100 per kg. This is the contract. Okay. On settlement date, agreement always happens earlier and settlement happens later. On settlement date, on settlement date, on settlement date, suppose if the price happens to be 108, if price happens to be 108, you have two choice here: settlement on delivery basis, settlement on net basis. It can be mentioned in the contract, or people can mutually agree upon the day of settlement. Both are fine. Okay, on settlement day, market price happens to be 108. Okay, if you settle by delivery, if settle by delivery, if you settle by delivery, now at what price will you buy? Can you tell me? Will you buy at 108 or will you buy at 100 rupees? You have entered into a contract to buy at 100 rupee per kg. And now market price is 108 on the day of settlement. But you have entered into an agreement. Okay. If you say 108, I am going to buy, what is the purpose of this agreement? If I say I have to pay 108, why am I entering into this agreement? That in the agreement I'm mentioning that I will be buying at 100. I'm not mentioning the agreement that I'm buying at market price. I am mentioning the agreement I will be buying at 100 per kg. Market price happens to be 108. I have signed an agreement. It is 100. I hope you are clear. It's not 108, correct? So you are going to pay 108 and buy the one share. So buy that 1 kg, whatever the product, and pay 108 rupees. Sorry, pay 100 rupees. Okay. After that, you can keep it with you or you can sell it. Does not matter. Let's say you sell later. You sell in the market. You purchase 100 rupees. Now you're selling it. You're selling in the market without any agreement. At what price will you sell now? You sell at 108. You sell at 108. So what happens now? You make a profit of 8 rupees. Correct? You make a profit of 8 rupees. You purchase at 100 as per agreement. You sold in the market at 108. You made a profit of 8 rupees. If settlement by delivery happens, if settlement by net happens, settlement by net basis, you know what will happen? Settlement on net basis, the other person will tell you why you buy the shares and why you buy the product, unnecessarily buying cost, transportation cost, then selling the market. Ultimately, what is your objective? Your objective is to make profit of 8 rupees. I will pay 8 rupees. So you will receive net amount 8 rupees. How that 8 rupees comes? 108 minus 100. That is why it is called as net basis. You are finding the difference. Difference between what? Market price and agreement price. Difference between that. and you're receiving it. That's why it's also called as cash basis. Of course, if it is a loss, you would have had to pay. So ultimately, if you receive 8 rupees, that means your profit is 8 rupees. This is the two settlement mechanisms possible. Ultimately, remember, both effect will be same. So in delivery basis, you execute the agreement, then you go to market, you sell, you make a profit. On net basis, you will cancel the agreement. That is an important feature. In net basis or in cash basis, the contract is not executed. Contract is cancelled. The contract is not executed. It is cancelled. Contract is not executed, correct? Because you receive 8 rupees, but you enter into an agreement to buy at 100, that agreement cancelled. The difference only we take, that difference will pay in cash. This is called as net basis settlement. So what is the feature of net basis settlement? Agreement will be cancelled, difference will be paid in cash or paid out in cash, and ultimately the effect will be same in delivery basis, in net basis. Delivery basis is easy, but net basis you should be more careful. Net basis means contract is cancelled. Please write, make a note of it somewhere, very important. Net basis means contract is not executed, contract cancelled. Difference may be paid in cash. That's why it's called as cash basis. And ultimate effect is same on both the cases. So in the exam, some problems I'll show you. You can show solution in settlement by delivery basis. You can show the settlement on net basis. Ultimate profit will be same. Ultimate answer will be same. But the way you get that answer, it will be different. So if the question is silent, you can use both ways. Hope you have taken down till here. Settlement by delivery means delivery of shares. It can be anything. Any product you sell. In this example, I told you kg. It can be chemicals. It can be mango. It can be apples. It can be furniture. It can be mobile. Anything. Or it can be foreign currency. Any contract you sign, later you execute. That's all. That execution is what is called a settlement by delivery. What is delivery? You make a payment and you get the shares. That's all. Even let's say you think of a car. You know what is the car? You always book the car, or you want to buy like some Royal Enfield bike. 9 months in advance, 10 months in advance, you book. You make the payment, or you make the payment later. You book it, means you're signing into an agreement. Maybe 50% you pay advance, and when the when the car or bike is ready, you pay the balance 50% and you get the bike into you. That's all. That is called a settlement by delivery. It might be shares also. It may be product also. It may be anything. I'm just talking about general terminology here, which will also be applicable in shares in derivatives. That we are going to apply it later. But now understand in a general context. Mediator kind of business will come. I don't know what is mediator kind of business. In net basis, what is happening is the contract is not getting executed. That is a convenient part. So I would say net base is more convenient. That's all. Because the agreement what you entered, will not be executed. Instead, the difference will be settled so that ultimately impact is same. Okay, I'll just explain one more situation. Same thing. Let's see if you're able to make more sense of it there. Okay, I'll just try to explain that part. See if you're able to understand. Uh, okay, let's say you are purchasing rice from a particular shop every month. You have signed a contract. You are telling that every month we want it. At you signed a contract every month I want. Now only I'm paying you the money. Also maybe let's say rupees. I don't know the price. Let's say rupees 100 per kg. It will not be so much. Example purpose. 100 per kg. Every month he is selling. He is giving you. Every month he is delivering. But one month he is not short in. He is not having products. His the stock is not there. But you tell, hey, agreement is there. Give me somehow. You purchase from somewhere and give me somehow. But market price happens to be 108 rupees. Now what that one shop or that fellow can do to honor your agreement, he'll go to market, purchase and give it to you at 100 rupee per kg. He can do that. Or what he can do, I will pay 8 rupees to you, can you go and buy yourself? Ultimately what will be your cost? 100 rupees, 108 you pay to outsider, 8 rupees I am paying it to you. So your loss I'm compensating, the incremental price I'm compensating. So effective price will be same for you. We are little busy, please understand my situation. I'll pay the difference to you, go and buy somewhere. Does that make sense? Settlement by net basis. It is not just limited to shares. It can be applied anywhere in your life. But of course, when we go discuss going forward, we take shares as the basis. I hope you understood the settlement by net mechanism. It's important because when I go further, I will not explain this detail. I just say settlement by net basis, cash basis, over. I'm sure you would have used this lot in your practical life also. I'll pay the difference. I'll pay the difference you try to manage. I'll pay the difference. Sometimes even these guarantee schemes will come. Minimum guarantee on stamp will come. They say, this is the minimum price you can get in our website. If you show anywhere else more than this, we'll pay you the difference. They will not tell go and buy there. You buy from us. If it is cheaper, the difference I'll pay it to you so that both are made equal. Hope you understand the practical implications, practical utility also in this mechanism. Okay, so let's go further. Okay, this we have discussed. Charts are there for you to revise. Concept, I have covered it. Okay, these two are critical words. Long position, short position. Going long, going short. It's a very simple thing, but lot of concept that you have to understand here. Let's understand basics here. Taking long position, taking short position. Okay, these are the two common words we are using. We are going to use a lot in stock market. Technical words. So when I say long position, short position, don't think literally long, short. Don't think like that. It's a technical word. Like in chemistry and all, they say technical words. We also have our own technical word. Long, short. Stock market. two things can happen. You know, I can tell astrology of stock market. On any given day, two things can happen. What is that? Only two possible things. Either stock market goes up or stock market will fall. Only two situations are possible. I know how much possibility is also there, but in that sense, it's a binary event. Either goes up or comes down. I've seen some YouTube videos people are telling, in my opinion, tomorrow I think market goes up or market comes down. I will be right. See, I told you. See, I told you. I've seen so many YouTube people telling what they would have told in the morning. Either it goes up or comes down. In the evening, they tell, see, I told you, it has come down. You're told both. Easy to fool people. Anyway, let's come to this. For you to make money also, be it in a short run or in a long run, in any time frame, your view must go right. In any walk of life, first of all, you have to have a view. So long position means you need to take a view. What view you're taking? Share price will go up. So this is taking a view or opinion. Taking a view. Market price of the share or the index, whatever, market price, MP, market price will rise, will go up. That is the long position view. Be absolutely clear about it. If I am thinking market will go up, that is layman language. What is professional language? I am taking long position. Okay, what is ultra legends language? We are going bullish. Bullish market. You know, they would have used the word bulls. I mean, by nature of animal. Bullish market. It basically means they are taking a view, market will go up. That opinion, that sentiment, that position is called as bullish. Okay, now tell me, if market goes up, as per your expectation, market goes up actually. You have taken a view, market will go up, and market has gone up. Market did go up. Market did go up. Then what will happen? You make a profit, right? I will tell you how it happens. You make a profit. How? Uh, you were expecting the market price will increase. Market price did increase, so you made a profit. I'm going very slow here on my dear friends. You also write down parallelly. These two positions can make or can break your understanding in derivatives. Somehow people are always confused here. What to do, what not to do. So I'm spending time here on this. So taking a view, market will go up. If market did go up, that means your view became true. Happy, you make profit. If market price comes down, if market did not go up, market did come down, market came down. It went against your expectation, so you are going to suffer a loss. Okay. What is taking a short position? They are called as actually bears. They say taking a view, market price will come down. Taking a view, market price will come down, will fall, or market price will fall, will come down. Market price will fall. If market price go up, market price, market go up. Now, can you tell me what will happen? Did your view became true here, or did the market went against your expectation? It is against your expectation because you are thinking it will come down, but it went up. So in that case, it is going to be a loss. But if market did come down as per your expectation, if market price come down as per your expectation, then you are going to make a profit. This technically people call it as bearish or bears. So people who are expecting the market price to go up are called as bulls, the big bull you would have heard of. And the people who are expecting the market price to come down, they are called as bears. Their sentiment is called as bearish. What is in, even there is one English movie called as The Big Short, which explains about the shorting concept as well as the 2008 economic crisis, Lehman Brothers crisis. English movie, if time permits, you can watch. It is there in Netflix or something. Okay. What is an important takeaway from this? You can make profit when the market price goes up. You can make profit when the market comes down. You can make profit in both the situations. You can make loss when the market comes down. You can make loss when the market goes up. What is that important thing? So many people have a common opinion, right? Oh, if market goes up, I make profit. If market comes down, I make loss. No, that is not a right interpretation. You can make profit in both the situations. You can make loss in both the situations. But what is important? Your view must be correct. Your view must be correct. If the market goes in line with your view, you make profit. If the market goes against your view, you make losses. And that is why we say the trend, if you can observe, you can make profit when the market price goes up. You can make profit when the market price comes down. Okay, if I know market price will come down, I can take short position and make profit. How, sir? I'll show it to you. But I hope that one myth you should not have in your mind. Only when the market price goes up, we make profits. It may be true for people in general because for them, they take only long position. Basically, investments they do. No, I'll invest for 2 years, 3 years, 5 years. And the only thing they know is I will buy, I'll sell later when the market price going up. But it can happen reverse also. If you can take short position, I will tell you how to take short position. But are you clear with respect to the views that you are going to take? If I take a view, market price going up, if it happens, you make profit, else loss. If I take a view, market price comes down, if it happens, we make profit. If it goes against, you make loss. So stock market going up or coming down is not the reason for the profit or loss. What is the reason? What is your view and what is the reality? If your view is correct, you make profit. If your view is wrong, you make loss. Does not matter where the market goes up. Your view is more important and market reaction to that is more important. There are even more complex strategies. In options, maybe if time permits, I'll tell you. If market goes up also you make profit. If market comes down also you make profit. But if it goes beyond certain range, then in both the case you make loss. Such a beautiful derivative instrument option. What I told you, no, market goes up. If your expectation was going up, you make profit or you make loss. If market goes up also you can make profit. If market comes down also you can make profit. That is possible in option derivative, option strategies. If time permits, we'll discuss later. Such a beautiful thing the stock market is. It can give profit to anybody who can take a view. View may be going up, view may be coming down, view may be within a particular range, view may be outside a particular range. Be it any view, stock market has a strategy for you. But what is ultimate common thread for all? If your view becomes correct, you make profit. If your view becomes wrong, you make loss. It may be going up, it may be coming down, even it is within a range. We can take a bet. Oh, market price of Infos will be between 1300 to 1800. Can I take a strategy? Yes, there are strategies: straddle, strangle, iron condor, iron fly. So many are there. We'll discuss going forward. But important is have a view. Having a view is the utmost essential aspect. Okay. Hope you got the basics very clear. Now I'll go to the one by one. What is long position and what is short position? Okay. What happens in long position basically is this. You buy first, sell later. Whereas in short position, reverse happens. You sell first, you buy later. How is it even possible? You sell first, you buy later. We'll discuss all those things one by one. Okay. Let's talk about long position now. Okay. Let's talk about long position. What I just told you, you buy first, now and later. Okay. Now you bought, you purchased, buy. Let's say 100. Later, you're going to sell. At what price you can sell, I don't know. Let's say two situations. Market price happens to be at 108, or market price comes down, it comes to 90 rupees. If it goes up, you make a profit of 8 rupees because you are selling at 108. Simple logic, right? I am buying at 100, selling at 108. My profit is 8 rupees. If it comes down, I'm selling at a lower price. I'm making a loss of 10 rupees. I think long position is not that complicated. Short position is where many people have difference of opinion. Short position. Now, later. Okay. Now you are going to sell at 100 rupees. Observe, you are selling first. So you sell now at 100 rupees. Later, two things can happen. Either market price goes up or comes down. What is happening in short position? You sell first, you buy later. You buy later. You buy if it goes up to 108 or it comes down to 90 rupees. If it goes up to 108, what will happen? You sold at 100, you are buying at 108, which means you make a loss of 8 rupees because your buy price is more. You are buying at a higher price, loss. If you sell at 100, you buy at 90, you're buying at a cheaper price, you make a profit of 10 rupees. You see, in long position, you made a profit when the market price went up. In short position, you made a profit when market price came down. If it was against your expectation, you made losses in both the cases. Write down this example. Ultimately, short position means this. You sell now, buy later. That can be achieved in different mechanisms. Using futures, I will tell you. Using options, I will tell you. In intraday, I will tell you. Many more mechanisms are there. But first, you try to get the process. Short position means sell first, buy later. That is slightly new to you. Sir, we have heard buy first, sell later, okay. But sell first, buy later, how is it possible? It is possible. I'll tell you how. Okay, hope you got it. I think long position, I need not teach you much. You buy, sell later. I think that is very clear to you. Short position is what you want to understand, right? How is it possible? So, shall I talk about more short position? Anybody has concern in long position? I buy shares, I sell later. Very simple. Okay. But one thing I told you at the beginning, our basic assumption of zero position. So let's say you're starting with zero position. In long positions, you're telling buy now. Where do you get the money? What is the starting point in long position? Buy now. To buy, where do you get the money? Where do you have the money? You tell me. You have to borrow. You don't have money. Zero position. So we'll start with borrowing. Yeah, own money also will have opportunity cost, but we'll treat as separate thing. So you have to borrow money, right? That is the starting point for a long position because zero position is the common point among every strategy. Short position means you have to borrow shares or borrow products, borrow shares or commodities, whatever you can say. Example, I'm giving shares, but it can be commodities also. I'll explain. Okay, shorting mechanism. I'll explain. It will take some time. It's okay. You have to be very clear about it. Okay, let's understand short mechanism. Okay, shorting mechanism. Shorting mechanism. Okay, let me give an example of which example should I give first? Uh, okay, let me give you one situational on shares example. Then I'll give you commodity example. Then I can tell you more logical and structural. Okay. You remember I talked about three aspects in stock market trading. You remember three aspects I told you. Whenever you want to buy the shares, what is the starting point? Of course, you open a demat account. What is the first step if you want to buy the shares? Do you remember? You have to place an order, not fundamental analysis. That is about analysis, but in steps. I'm talking about the actual steps, physical steps. I don't know how do you call. You have to place an order, and then after that, what next? Once you place an order, the moment you place an order, will it be executed? No, right? It after order, a trade will take place. Trading. I showed you practically also. Hope you remember. Order, a trading takes place, and then a settlement will take place. A settlement will take place. So the moment you place an order, it will not get executed. Order should be matched. And once the trading takes place, immediate settlement will not happen. Yes, it will take T plus 2 days practically. It was even more. It was 1 week, 2 week earlier. Now it became digital. So it's even more faster. But older days, it was even more higher. So try to think of not T plus 2 days. Let's say like a 1 week time is there. Now, let's say you are a seller. You are a seller of shares. So what you told the broker, you took a call and told the broker, sell Infosys shares. Sell Infosys shares. Sell Infosys share. He will not ask you, do you have Infosys shares with you? He will not ask you that. Don't think practically now yet. Practical aspect is different. First, try to understand the theoretical aspect. Then we'll go to practical aspect. He will say, you want to sell the shares? Okay, I'll sign a contract signed. Okay, he will go to the market and say, I want to sell, 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 sell. Somebody says, I want to buy. You say, sell. Okay, trading takes place. Let's say the trading price was fixed at 1,000 rupees. 1,000 rupees. Now, 1,000 rupees is in your account that you have to receive from your broker. And what you have obligation, you have to give the shares. Okay, let me just give it to you. Example, let's say you are there and broker is there, and you gave an order. You told the broker, place the order, and broker also placed the order in the market with somebody else. He placed the order as well, and they have paid money or money receivable, okay, amount, money. So now what are the obligations you have? What are the rights you have? You have to deliver shares, right? Earlier you just placed the order, you did not deliver shares, you just told sell though, sell it, just takes. Voice is breaking. Is it the case with others? Is the voice is clear? Fine, right? Okay. Okay. Now coming back. So you have placed the order earlier. Now what obligations you have? Earlier you told I will give you shares. Now you have to give shares, right? You have obligation to give shares. You have obligation to give shares. You have obligation to give shares. And once you give shares, what you get is money from broker. Hope you understood. Till here what happened? You placed the sale order. Broker went to the market, he put the sale order and he sold the shares. That means trading. He did not physically sold it. He signed a contract. He signed what contract note. And let's say the money was at 100 rupees that time. Now you have 1 week time. I'm not talking about T plus 2 here. I'm not talking about today position here. I'll talk about today position later. You have 2 days time to deliver the shares. Even SEBI was not putting the restrictions earlier. And after that only, SEBI start putting some more restrictions. Because earlier, everything used to happen between you and broker. You can call the broker without money also. You can tell, buy the shares, I'll give money later. He says, okay, no problem. He'll buy the shares, then you make the payment. Like here also, you told the broker, place the sell order. Then when delivery comes, I'll give you the shares, don't worry. That happens. So now broker did what you have told him to sell the shares. He sold the shares. Money will be paid to you. But when will you get the money? You don't get the money yet. When will you get the money? Only when you deliver shares. So you have obligation to give shares. You have obligation to deliver shares, to give shares. And once you have obligation, you fulfill, you get the right to receive money. Right to receive money. Okay. Now, before you deliver the shares, now you keep getting calls from broker, right? I sold. When will you give the delivery? A buyer is asking. Please give me the delivery. Buyer is asking. Give me the delivery. Buyer is asking. Now what do you tell? I'll place one more order. So what you did? You are placing one more order with the broker next day or 1 or 2 days later. You are placing the order that go and buy the share in the market with somebody else. You buy the share. Market. He places the order. Place the order. To buy. Let's say that also happens. But next day, the share price 100 rupees becomes 98, let's say. So how much broker has to pay to the market now? He has to pay 98 rupees. 98 rupees. Okay. Now you tell me, what are your obligations and rights in this transaction? In this separate transaction, you are having an obligation to give money, right? How much obligation to give money? Obligation to give money. Obligation to give money of 98. And what is your right to receive shares? Right to receive shares. In fact, there's a beautiful scene in the Scam 1992 web series. There's only 1 or 2 minute clip. That's also a good one. You can watch it. Okay. So what happens now? If I mix the two transactions, you had obligation to give shares and right to receive shares. So that will get cancelled. And earlier you are having a right to receive money for 100 rupees. Now you have an obligation to pay 98. So this will get cancelled. How much will come to you? 2 rupees will come to you net. So on day 1, you sold at 100. On day 2, you purchased at 98. The 2 rupee profit is in your pocket now. You don't have to deliver shares. You don't have to buy the shares. Both got cancelled. You made a profit because market price came down. A broker will pay the money. Broker will settle it accordingly. Because buying the shares, selling the shares for him also, it is offset. That is called as shorting mechanism. I hope I know you will have lot of questions. How is it possible? But again, I believe you understand the overall mechanism, how it works. I'll tell you more about it. I'll tell you more practical aspect. Then how you can do it practically. We'll try to see all those things. I'm trying to just put the seed in your mind. How things can happen. It's possible. It was more easier earlier. Now a little bit difficult. Why it's more easier earlier? Because when you place a sell order, you don't have to have anything. You tell sell, 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 no problem. You tell sell. Then he will ask, give me the share. You tell, make one buy order also. If the price has come down, you have to give only the difference. That's why net settlement is more important in this context. The difference. If it came down, you make profit. If it goes up, you make loss. Okay, this is just to give you an idea what used to happen. I'll give a better picture, a better process which happens even today. Will understand, and from exam point of view also will understand what point to be kept in mind, like interest what happens, dividend what happens, all those things we have to analyze. We should write some more sentence also. But do you have any questions? In first case, money will not be paid by person, but you being a person, why will you pay the money? You sold the shares, right? You have to deliver shares. Your money you have to receive, not paying the money. You are placing the order for selling. You are placing the order for selling. So why will you pay the money? You will receive the money. I mean, you have to receive. You will not receive, but you have to receive once you deliver share, of course. And what will happen to broker position? Very simple. Now the broker will have the money with him, or whatever money he can make use of, and he can buy the share and he can sell it there. So that settlement will take place. Okay. Any other doubts? Okay. I know you need to get some more clarity. You need to get some more confidence. That and all will happen when everything is given in a tabular point of view. So while solving problem, look at the table, follow it. So once we reach that stage, you get the absolute confidence, in my opinion. We still have some more way to go. I think before that, we'll take a small break. Let's take a break of 10 minutes, then we'll move forward. Okay, let's start fresh now. So whatever I told you regarding the shorting mechanism, for the time being, you can forget about it. Let's start fresh. This is what is going to be required now. Focus. It's also called as stock lending mechanism, but let me give you the uh, basics now. So what is required theoretically, pure theoretical process is what we are going to apply it now. It's applicable for institutions also, but for individuals, this process may not be applicable. But let's not think about practicality. Let's purely think on uh, theoretical aspects. Shorting process. Shorting mechanism, pure theoretical. What is the basic objective? Two simple transactions that is taking place. You sell first, you buy later. Okay, let's not think about the shares for the time being. Let's not think shares for the time being. Let us think, let's say, commodity. Let's say oil, petrol. Now, can you borrow that? People because always tell me, sir, how can you borrow shares? So, starting point in this mechanism is going to be borrowing. Borrow shares. Borrow shares from somebody. People always ask, how is it possible to borrow shares? Okay, then I'll ask, can you borrow commodities? From your neighbor, you can take little bit of sugar, rice, sugar, let's say, or coffee powder, something like that. You borrowing always exists, right? In fact, in the uh, barter system, we always used to borrow in commodities because money was not there at all. Somehow we are not exposed to it, so we don't believe that. You can borrow gold, you can borrow oil, let's say oil, you borrow and you sell. Borrowing is possible. Later you can give it back, of course. Even in your childhood, you would have borrowed pencil and all from your friend, pencil, pen. In class also, I've seen a lot of people borrowing calculator. Of course, I don't see them returning it back, but it's possible. The conceptually, borrowing is possible. So the starting point is borrowing shares. Okay, that's the starting point. Once you borrow the shares, you sell today in the market. You have the shares with you now. Sell in market. Sell in market today. Okay, let's say you receive today price at 1000 rupees. Example I'm giving at 1000 rupees. Now you have the money with you. So you have money of rupees 1000. Because you sold the shares, you got the money. Later, point in time, you have to repay the shares, right? Just like you borrowed the money, you have to repay the money. So you will repay the money. When you have to repay the shares. For that, what do you do? With that money, utilize this money, utilize this money. In fact, if you are doing it after 1 month or 2 months, you can even deposit this money and generate interest also. Anyway, for the time being, utilize this money and use that money for buying the share in the market. If, as per your expectation, if the share price did go down, let's say, buy in the markets at, let's say, rupees 900. The market price would have changed, and as per your expectation, let's say market price has fallen. So you'll be buying in the market 900, and now what you're going to do? You're going to repay shares. You are going to repay shares. Now borrowing shares earlier you did, now you repay shares. So this position is set off. In the sense, this is closed. This is repaid. This is closed. Now earlier you sold at 1,000 rupees. Now you got 900. So difference 100 rupees is your profit. This is also called as stock lending mechanism. Stock lending mechanism. This is possible even in practical life for institutions. For individuals, this shorting mechanism may not be possible in a larger manner, but for institutions, this stock lending mechanism definitely applies. They do borrow from shares. They do borrow shares, maybe from brokers, maybe from some other institutions. Let's see, when you borrow money, you have to pay interest. When you borrow shares, what you have to pay? There will be some charges. Between borrowing and repaying, there will be some charges like commission brokerage. But while solving the problem, we assume charges are not applicable because every time I buy the share, I'll have to pay brokerage. I sell the shares, I have to pay brokerage. But while doing analysis like portfolio management, we just took P1 minus P0, right? We have not taken brokerage and all into consideration. So transaction charges we ignored. Brokerage. Here also some commission will be there because they are lending, because risk of default is always there. For the risk of default, there will be some compensation. Charges will be there. But time value of money will not be there. Sir, what is that? You borrow 10,000 rupees today and you repay 10,000 rupees after 1 year. Do you think its value will be same? The purchasing power would be different, right? That is why you have to compensate, called as interest. Yes, the value of money comes down. To compensate only, you pay something called as interest. But that thing does not happen in borrowing in shares, because shares will not depreciate, right? Or when the things will not depreciate. If it depreciate, of course, you have to compensate. We'll come to that. So you take shares as it is. You have the shares today. After 1 year, you give back the shares. No depreciation. Share quality did not reduce. Sir, share price would have reduced. That is a different question. How is a different question, sir? Share price reduced means loss only. No. Let's say you hold Infosys shares at 1,000 rupees. You just hold because you are taking a long position. After 1 year, it has come down to 900. So you did not do any lending. You just hold it, keeping long position. So market price went down. You suffer loss 100 rupees. Compare that with you lent at Infosys shares at 1,000. You lent the shares. Now you got back the shares at 9 rupees market price, loss of 100. So between holding and between lending and getting it back, your position is same. So there is no interest to be paid. Some charges will be there because risk of default is always there, because you lend the shares. What is the probability he will give it back if he does not give it back? So there is always that risk is there. For that risk, you are going to collect some charges, but there is no depreciation. There is no compensation for that aspect. Utilize money. Sorry, I did not get the question. You utilize this money. That's what I've written. Utilize this money means later you have to buy the shares. Where the money comes from? What money you have got from selling the shares? So what money you have, that money is utilized and that is used for buying the shares. Okay. Hope you got it. The lender of the share will not lose anything as compared his situation with holding it. That is why, apart from charges, the lender will not get anything. Some charges only, commission, but beyond that, no interest and all will be paid. Okay, I hope you got it. Now let me do one more summary once more. From exam point of view, what and all point to be kept in mind. Let's prepare in a tabular format. So while solving problems, any new things comes, that will be very clear. Hope it is fine. Okay. Let's talk about long position also, short position also. Okay. Now I'll write two columns, transactions now and transactions later. I will discuss with respect to long position, and I will also discuss with respect to short position. What I'm writing it now is summary of everything what we discussed and what is required for solving the problems. So this one page, what you're writing, make it very important. Three positions I would say, or I'll say two. On money, what you're doing. On shares, what you're doing. Okay. Long position. What you are doing with respect to shares. Shares or underlying asset. Tell me. Long position. What was the key mechanism I told you? Buy first, sell later. Buy what? In this example, buy shares. So today what you're doing? You are buying shares. That is clear? You are buying shares. You are buying shares. And money, you tell me, what will happen on money position? Money market, share market. Anyway, I told you buy shares. But where do you get the money? If you have the money, it's okay. But zero position, where do you get the money? We borrow, right? That's a starting point. Let's say you don't have the money. You borrow. You borrow. Your own money also will have a cost. I told you. Okay, this is the position now. What will happen later? You have to sell the shares. Later, you have to sell the shares. You have to sell the shares. Borrowed once earlier with money. Now you have to do what you should do. Simple concept. You borrowed earlier. What is the logical consequence now? You repay now. You repay. So what is the series of transactions? You borrow money. Then with the money you borrow, you're going to buy the shares. That arrow will tell you. Sentence we don't want to write. You have money. You borrowed the money. You have money now. Buy the share in the market. Later, that share you have, you sell the shares because you already bought the shares. So now you are selling. Later you are selling. And once you sell the shares, you get money. That money, use it for repayment. So you borrowed earlier, now you repaid. Now, but repayment has to happen with one more thing. What is that? When you're repaying, you have to repay along with interest, right? You also have to pay interest. You will have interest expense. Time value of money basically. You will have interest expense. While repaying, you will also pay along with interest expense. Of course, if it is your own money, you might have opportunity cost. If you ignore opportunity cost, then there is no cost. Only the buying and selling becomes your profit. So interest expense. Okay. Now when you hold the shares, also you can get some income. Can you tell me what is that? Between buying the shares now and selling the shares later, by holding the shares, you have one benefit before you sell. Can you tell me what could be that? Simple only. You have bought the shares. Later you're selling the shares. When you hold the shares, you have one benefit. Interest. For holding shares, you get interest. I doubt. Dividend, right? Absolutely. Dividends. You will receive, if at all. All company may not pay, but if some company might pay, dividend is going to be your income. If at all, if you receive dividend inflow. Interest was expense, dividend inflow between these two markets. So between the money market, borrow, repaid, interest will come. Between buying and sell shares, when you hold the shares, dividend might come. That is inflow to you. So what is the overall profit if you have to calculate? Overall profits, if you want to calculate, it is the sell price minus buy price, that you know, sell price minus buy price, plus dividend receipts, that is inflow, minus interest paid. If you consider, if it is own money, if we don't consider opportunity cost, then interest expense will not come. Otherwise, this will come. Interest paid. So sell price minus buy price plus dividend paid, plus dividend received minus interest paid. This is the overall profit in long position. In some problem, dividend may not come. In some problem, if you don't use borrowed money, interest also may not come if you ignore opportunity cost. Simple enough to understand long position. Let's do short position. Short position. This is critical, crucial. Many people go wrong in this. Okay, now later, two markets as usual, money, shares. Okay, now you tell me, with respect to shares, in short position, what is my transaction? What is my first transaction in short position on shares? You borrow and sell, right? You sell, but for you to sell, you have to borrow. Not in money, you are borrowing in shares. So now what is going to be there? You borrow and sell. You borrow it and immediately sell it. That is what you do with respect to shares. Once you sell, what do you get with respect to money? You get money. What do you do with respect to money? Because you are going to transact later. Some time gap is there. What you do with respect to money? I don't say buy money. I will say deposit. Money is coming to you. In a way, you can say buy. But that's not a very right thing. I'll say deposit. Buying only. Money is coming to you. So in a way, buying. But I will say deposit. Deposit money. Okay. Later, what will happen to this deposit? Deposit matures, right? So later, deposit matures. Deposit matures. And with the deposit, what do you do? You are going to buy the shares. Later, you are going to buy the shares. And what do you do after buying? You repay the shares. So you are going to buy and repay the shares. Repay the shares. Now for deposits, later maturity, what is the compensation you receive for this time gap? You will have interest. You depositing the money now, you are getting the deposit later, you will have interest income, right? Because you deposit. Interest income. This point, what I'm right now, what we are going to discuss now, simple point, critical point. So let me see if you have any doubts still here. Deposit in demat. We are depositing money. Why I'm depositing money in demat account? Demat account don't give me any interest. One, I sold the shares, I get the money, I deposit the money in bank account, I deposit the money in fixed deposit, I deposit the money in recurring deposit, I deposit it in liquid funds, wherever it is, where interest free, I mean risk free. I don't want any risk, but you know, time value of money is there. That interest income, I'm talking about time value of money, basically. Got it? Okay. You can deposit wherever you want. Demat will not give me interest income. Demat account is shares are held, but I don't have shares now. I have money now. Shares, demat account. Money, bank account. Are you understanding the parallel? Beautiful parallel here. The money means bank account. Shares means demat account. Money will get credited to bank. Shares will get credited to demat. Ultimately, they are accounts, maintaining shares, maintaining cash. Okay, fine. This is going to be very critical one. Understand carefully. Between borrowing and selling shares and later buying and repaying shares, what you have to consider is dividend outflow. Dividend outflow. When you are taking long position, dividend was inflow. When you take a short position, dividend is outflow. Actually, to remember is very easy. In a long position, interest expense was there. In short position, interest income is there. In long position, dividend inflow is there. In short position, dividend outflow is there. So basically opposite. Very simple. Logic is very important, I'll tell you. But I'll tell the simpler thing first. Okay, now I'll show you one more manner to make it simplification for your understanding. But first, let me tell you the logic. Then I'll tell you balance sheet approach to understand this. There, I think you appreciate better this concept. But anyway, let me explain the logic here. If you remember, borrowing money, later we repay money. What is the reason for paying along with interest? Because the value would have depreciated. The value of money would have depreciated. As a compensation, you have to pay interest. Same thing now. When you hold the shares, now tell me little bit of basics. What we discussed in dividend chapter, corporate valuation chapter. When a company pay dividends, what will happen to share price? Keep very simple for the time being. Forget all these long and short. Think fresh, think in clean mind. You hold the shares. When the dividend is paid, you know share price will fall down. That's called as ex-dividend price. But now tell me from shareholder point of view, is he at a loss because share price is falling down? Is he at a loss? No. Why is not a loss? Because when the share price fall down, he receives dividend, right? One loss will compensate the another. Are you understanding? I am a shareholder. I receive a dividend due to which share price has fallen down. So share price fallen down is a loss. Nothing to worry. Dividend is compensating for that. So net to net basis, there is no impact on the date when the dividend is paid on the net worth of the shareholder. Now coming to this position. Now come to this position. When a lender gives the shares, share price was at that price, and when the shares comes back, repayment happens. If the share price fallen down due to other reasons, okay. But if it is due to dividends, share price has fallen because of dividends, that a loss is not your loss, right? Are you understanding? That loss would not have happened to you had you hold the shares. Had you continued to hold the shares, had you not given the shares to somebody else, you would have continued to be the shareholders and you would have received the dividend. So reduction in the value of shares would have been compensated because you have received dividends. Other reasons, share fall, that would have happened anyways. But for the dividend decrease, dividend payment, for that reason, share price falling down. That is not acceptable. If you continue to be shareholder, you would have received a dividend. Now that you have lent the shares are not in your name. If the shares are in somebody else's name, so you need to be compensated for the loss. the opportunity of dividend that you would have received. So as a borrower, it is your responsibility to compensate the lender for the loss of dividends. So the borrower did not receive the dividend, but it is your responsibility to make the compensation right, to make the loss right by making the payment of dividends. That is why, in case of borrower of shares, dividend outflow will happen. We'll write in the sentences why this dividend outflow will happen. Only for this, I think we require one sentence for more clarity. Rest of it, if you still have any doubt, you can ask. We can write sentence if required. So only on the star point, you can write below. Okay, you can write below. Lender, lender of shares, lender of shares, lender of shares will lose the opportunity. Lender of the shares will lose the opportunity. The lender of the shares will lose the opportunity of receiving dividends. Lender of the shares will lose the opportunity of receiving the dividends, receiving the dividends during the period of lending, 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 which should be compensated, which should be compensated, which should be compensated by, which should be compensated by, which should be compensated by borrower, which should be compensated by borrower, which should be compensated by borrower. Hope you understood basically what happens when you take some assets, and if you, while giving back the asset, it should be in same condition. Like you take some mobile phone from friend, or you take some vehicle from friend, car from friend. While giving back, please give the car in same condition. If you break something, if accident happens, you have to compensate, right? That's what happening here. Sir, that means if share price was 1,000, later it becomes 900. Should a borrower compensate for 100 rupees loss? No, that loss anyway you would have incurred if you continue to be holder also. But this dividend he would have received if he continued to be the shareholder. So the loss which would have come anyways if he was a shareholder, that loss will not be compensated. But this loss is coming because he could not become a shareholder. He has given you the share for you to do some transactions. He lost the opportunity, that must be compensated. So reasons of loss due to dividend will be compensated. Loss due to other reasons will not be compensated, because other reasons he would have faced it anyways. But dividend, he would not have faced it. That is why he needs to be compensated. Simple words, dividend should be repaid. So overall profit calculation. Overall profit calculation is sell price minus buy price minus dividend paid. Dividend will be outflow. You don't receive it, but your obligation to compensate the lender because he has lost the opportunity. Dividend paid minus plus interest received, interest income. So interest received, interest income is going to be plus. Sell price minus buy price is same, but what is opposite is dividend received there, dividend paid here. Interest paid there, interest received here. If you have any doubts, you can ask. I am going to show in one more manner for your understanding to understand this better. But this is what is required for while solving problems. This one page is sufficient for you to do any problems in futures, in options, anything relating to the long concept, short concept. This page will have it. So this page should be your one page revision. Any number of times you want to revise it later. But to make you understand better, I'll show you in one more way. But any doubt till here, get it clarified. Okay, hope you're clear. Okay, very good. Okay. Now I think one more simple way of summary I'm trying to do. Let's see if you like it. Balance sheet way of understanding it, because we are so used to balance sheet format. Balance sheets, two things: you have assets, you have liabilities. Okay. Now if I'm explaining long position, what asset I have, what liability I have. I am buying the shares, so investment in share is my asset, right? Investment in share is my asset. Investment in shares is my asset. Now on asset, what is that income I get? Do we get income or do we get expense? We always get income, right? So on investment in shares, we are having dividend income. Positions today I'm telling. Liability, what you're having? You're borrowing money, right? You're borrowing money. And when you borrow money, what will you have? As a cost, right? You don't have income. So when you borrow money, you have interest expense. That's common sense. That you know it. Interest expense. This is long position. Borrow money, investment in shares, dividend income, interest expense. For the asset, we have the income. For the liability, we have the expense. Now coming to short position, also beautifully we will do it using a balance sheet approach. Short position. What asset we have here? Can you tell me? What asset we have and what liability we have in the short position? The money we have deposit, right? Deposit money we have. Money we received and we deposited. So asset side we will have deposits in money. And when you deposit money, what is the income you get? Interest income. And liability, what you have? You're having borrowing, but in shares, borrowing in securities, borrowing in shares. Borrowing in securities. And when you have borrowing in shares, basically liability side shares, who will have shares on liability side? Companies, right? Companies issue shares, they write shares on liability side, and for them dividend will be a payment, there will be outflow. So here dividend will be a payment, dividend payment. So borrowing is liability, so corresponding dividend becomes payment. Deposit money, corresponding interest income. So this is a beautiful summary. Balance sheet approach in long position, short position. I hope you can connect better with this point. Okay, so let's go further. Any doubts? Okay, let's go further. Good morning, my dear future chart accountants. I hope everybody is doing great. Can you please confirm first that my voice is audible and the PPT is visible? Okay, yes, thank you. We just finished basics of derivatives like basic assumptions, long position, short position, and also the objectives, speculation, hedging, and arbitrage. Terminologies we have understood, basic problem we have understood. Now we'll go to the coverage one by one. Typically, we will have problems on futures and options. That's what we say FNO segment. F and O. FNO, some people call it FNO. But we will have to understand forward contract. It is slightly different. But we will use it interchangeably. So let's understand first what is forward contract, and then we'll try to understand more about futures and options. Okay, let's give the heading forward contract. Forward contract, as the name suggests, it is an agreement entered between two parties. It's contract, right? You know the meaning of contract. You would have been specialist. Contract act. So it is an agreement between two parties. It is an agreement between two parties where one party sells. Obviously, other parties purchases. One party or one person sells, and obviously another person buys. Another person buys. What do they buy? Some underlying asset, maybe some product, maybe some I would say shares or index, whatever maybe. One person sells, other person buys an underlying asset, let's say, an underlying asset. What do they buy? I mean, at what price they buy? That is an important point. At a predetermined price on a predetermined date. At a predetermined price on a predetermined date. You understand? Predetermined price, you can also understand like a forward rate, or sometimes a future price, forward price. You know that is agreement price. Predetermined price means it's a forward price or forward rate. This is the amount that is going to be paid. That is called as forward price. Then predetermined dates, and that is uh, settlement date. That is settlement date. Okay, so simple example, I think you enter into a contract to buy some rice after 1 month, or manufacturing company enter into a contract with the supplier to purchase the raw materials for 1 month later. Forward contract. Even in futures also will come to the same thing. Okay, hope you written it. Very simple concept. Forward contract. So hope you understand. In forward contract, there has to be an underlying asset. There has to be a predetermined price. The price should be decided in advance. The date of settlement should be decided in advance. And settlement should take place later. And that is the nature of a derivative, right? It should always get settled at a later point in time. Okay. And now you tell me, when you enter into a forward contract, what is your initial investment? If you sign a contract to get some order, will you pay any amount? I mean, you might pay some nominal charges, but will you pay any amount? Like if you want to buy the uh, raw materials today itself, you will make the payment. But if it is a contract to buy after 1 month, maybe some advance you might pay, right? That's all. Beyond that, there is the cash flow will not happen today itself, because delivery did not take place today. You might pay some advance, nominal advance. Hope you got the point. Okay, that is about forward contracts. Okay, let's go to the futures then. Okay, fine. I'll go further. Now let's come to futures. Futures. Here is an interesting term. Futures are forward contracts, but some more limitations are there. So futures, please listen to me carefully. If I use the word future, don't think about future. There is an instrument called as future. I usually tell one PJ here, poor joke in this case. You know, there was one grandmother died at a young age. Do you understand? How can grandmother die at a young age? If it is, if person is dying at a young age, how can you call it as grandmother or grandfather? Because name of the person was grandmother. I know you feel like this is also a joker kind of thing. But my point is, if I talk about futures, don't think about the future. It is an instrument called as futures. I'll show you practically also, don't worry. Okay. Now, what is the future? It has all features of forward contract plus extra thing. It has all essential features of forward contracts plus extra features. Why extra feature? Because forwards are over the counter arrangements. What do you mean by understand? Forward means between two parties. Nobody else is involved. When you sign an agreement with a raw material supplier, other persons are not involved. But here it is through stock exchange. Extra feature because transaction happens through stock exchange. What is the stock exchange? Let's say because of the standardization that it takes place. Standardization. Because when you do, like for example, when you eat outside on the roadside, you don't have to follow any rules. But when you go to five-star hotels, there will be some dignity, table manners, some rules you have to follow. People follow some customs. But keeping it aside, when it is between two parties, there are no standardization to be done. You can enter into any number of quantities. You can settle anytime as per your agreement. So it's not bound by any external rules. It's between two individual people. But futures are instruments traded in the stock markets. And therefore, it is bound by some rules. What are those rules? What are those extra standardizations? Let me try to tell you one by one. Okay. So it will have a standard expiry date or fixed standard expiry date. Like in India, for stocks, we have monthly expiry happens on last Thursday of every month. On that day only, settlement will take place. So we have standard expiry date and that is settlement date. So if you want to execute earlier, can you do it? The answer is no. You have to wait for the expiry date to happen. You have to wait for it. This is one point. Then lot size. So you cannot enter into any number of units you want. For example, Reliance shares has got 250 lots. So one share, one lot will have 250 shares. You cannot buy 260 shares, 300 shares. You buy 250 or in multiples of 250, like 35, like 250, 500, 750. So no wholesale, I mean, it's only wholesale business, no retail business like that. So lot size, it has to be, quantity should be in this multiple. Quantity should be in this multiple. Quantity should be this multiple. That is called as lot size, odd lot, minimum units to be purchased, or multiplier, or lot size. So standard expiry date. So you'll have a lot size. These are all will not be there in forward contract, because forward contract you can enter into any amount you want. Okay. Then settlement type. Settlement type. You can do settlement. Two types of settlement we have understood. Settlement by delivery, settlement by net basis, right? But here you can go for settlement by delivery basis, but mostly it happens settlement by net basis. Settlement type, here we call it as either delivery basis, that is one choice is there, but mostly it will not be delivery, mostly it will be net basis. Settlement will not be happen by net basis, and that is called as square off. That is called a square off. I'll explain what is square off. Don't. I'll explain what is square of. Then mode of settlement. Because it happens on square of. If square of happens, and I mean, or even without that, we call it as MTM settlement, mark to market settlement, MTM settlement. MTM, mark to market settlement. I'll explain what is that. Then margin money is there. Margin is like a safety money, like safety, like deposit. Margin is like deposit. You'll get back when you exit, like deposit. Margin. We'll discuss what are the types of margin that exist. Let's see if I have to list out any other lot size, expiry, margin money, square of, mark to market. I think all the features I have discussed. Okay, hope you understood. I have to explain what you mean by square of. I have to explain what is MTM settlement. I have to explain what is margin money. I think these are the terms I have to explain to you. I hope you understood the meaning of futures, the meaning of forward contracts, and it will have a price, future price, just like the price which you have fixed. But I remember what is the most essential point. Whenever I say if I buy future, if they use the word buy futures, that means, I repeat once more, if I use the word buy spot shares, that means I'm making a payment and I'm getting the shares. But if I use the word I am buying futures, it means I'm entering into a contract. I buy future, I buy forward, it means it is entering into a contract. I am not purchasing the shares immediately. It is going to be purchased at a later date. Fine. So buying the future means you are entering into a contract. It is entering into a contract to buy for one person, to sell for other person. So it's entering into a contract to buy. That means you're not buying now. You are going to buy. Are you very clear? When I say I go to spot market, that means I buy the shares today, cash and carry. Whereas if I say I buy future, it means I am entering into a contract to buy. I repeat, if I say buy future, it means I am entering into a contract that I'm going to buy. I'm not buying it today. That point has to be very, very clear. So I should explain what is the meaning of square of, what is the meaning of mode of settlement, and what is the meaning of that is MTM settlement I should explain, and what is margin money, and maybe one more early settlement I should explain. Okay, so let me explain now what is the square of meaning. Square of. Okay, uh, this is nothing but this is same as we know we are two types of settlement. One is a settlement by delivery basis, other is settlement by cash basis. Hope you remember it in the basics we discussed. Square off is a name given for settlement by cash basis. That's all. Actually, it is nothing but it's a mechanism applicable for settlement by cash or called as net. Do you remember what do you mean by settlement by cash or settlement by net? If you enter into an agreement to buy shares, let's say on 30th of September on some year at rupees 1000 rupees, on 30th of September, you pay 1000 rupees and you get the share, that is settlement by delivery. You signed the contract earlier, you execute the contract now, that is settlement by delivery. So let me just quickly revise it to you. You enter into a contract. You enter into contracts today and later you execute the contract. You execute the contract. You execute the contract. In a sense, by you pay money and you receive shares or receive delivery of shares. You receive shares. That is what is settlement by delivery. This is settlement by delivery. But what we're discussing is not that. You enter into a contract. You enter into contracts. Okay. On net basis. On cash basis. Do you remember we discussed in the basics? Do you think the contract is executed or contract is cancelled? What do you think? Do you remember? In settlement by cash basis, contract is executed or contract is cancelled? Contract is cancelled, right? Yes, contract is cancelled. Contract cancelled. So when you sell the contract, you don't receive the shares. Delivery will not happen. So no delivery of shares, no transfer of shares, no delivery. And difference will be settled in cash. Either you receive cash or you pay cash. So what is the difference is between the differences between agreement price, difference between agreement price, that is contract price, what you entered in the contract. Let's say that is a future price entered as per contract. Agreement between uh, future price and market price. Future price means agreed as per contract long time back, and market price, the difference is paid in cash or received in cash. This is net in cash. Net in cash. Okay. Now a question comes, but let me just read my handwriting. So enter into a contract initially, later contract cancelled, delivery did not take place. The difference between BW, difference between future price means agreement price and market price on the date of settlement. So future price agreed earlier, future price agreed earlier as per the contract, and market price on expiry date, on settlement date. Market price on settlement date, the difference between those two may be paid in cash, received in cash. I just said net in cash. That is what is settlement on net basis. Hope you know the basics. This contract is cancelled. No. How will you cancel the contracts? Okay. Now tell me legally, how can you cancel the contract? You know, contract is an agreement enforceable in law. So how can you just cancel it? Okay, that is where this word square off comes. Listen to me carefully. How the contract is cancelled? Consent of both party, no, not sufficient. Consent of both party not sufficient. We have to give an effect. Why consent of both party not sufficient? I'll tell you now. I'll tell you, listen to me. If you know, okay, I signed a contract with other person, okay, I am cancelling, you say yes, yes, cancel. But what is the problem with the futures? When you're transacting through stock market, you don't know the other party, right? The other party with whom you're signing the contract, you don't know who is it. There will be one person, but you don't know who is it. So you can't get his consent. You can't get his consent to cancel. Hope you understand the practical implication why in futures you can't get the consent of two parties, because other person is not known to you specifically. And a stock exchange cannot give you phone number, mobile, email ID, go and talk to them. That becomes thousands of transactions. It is not feasible. But we follow this beautiful technique, square off, which will have the impact of cancellation. We cannot cancel the contract due to practical limitations, but we do the square off, which has the impact of cancellation. I'll tell you now. Very simple. You know how do you cancel the contract? Entering into opposite contract. Entering into opposite contracts. Entering into opposite contract. Entering into opposite contract. So earlier you enter into future buy. Let's say you enter into future buy contract. And today it is going to be future sell contract. Effectively for you it is cancelled. The contract is in really not cancelled, but effectively cancelled. I hope you are getting this beautiful point. I'll give an example. Hope you written till here. Okay. Okay. Example. Let's say on 1st of Jan, or let's say whichever date, 1st of Jan, you sign a contract to buy 1,000 shares of Infosys on 31st of Jan at a price of, example, 1,000 rupees. Just for example, 1,000 rupees not the share price of Infosys, example purpose. Rupees 1,000. What is this 1,000 rupees called as? This is called as the future price, trading today in the market. Future price, trading today. I'll show you practically what do you mean by that. Future price, trading today. And what is this transaction itself is called as? Because you're signing a contract, this is called as future buy. You're entering into a contract and at a price of 1,000, that is the price fixed in advance, Infosys shares, and you're going to purchase on 31st of Jan. So 31st of Jan is the settlement date. And you know, futures will have a fixed settlement dates. In fact, we are having 1 month, 2 month, 3 month expiry. We cannot buy more than that. Anyway. Now, can you tell me, on 1st of Jan, how much I should pay? On 1st of Jan, how much I should pay? How much cash flow happening on 1st of Jan? Nil, right? Nothing. Zero. At this point in time. Margin and all, I'll come to it later. I hope you understand. I am not paying it today. I am going to pay after how many days? After 30 days? After 1 month? But today, I am just entering into a commitment like an engagement. The price, in whatever means you can call, will be paid later on the day of settlement, on the day of expiry date, but the amount is decided in advance, the date is decided in advance, as the process of signing the contract is called as Future buy. Hope you make the meaning of it. Future buy. If some common man listen to it, he will laugh. How can you buy future? Future buy means in future I will buy. Simple English. Future buy means in future I will buy. I'm not buying it today. I'm today just signing into a contract. Okay. On 31st of Jan. On 31st of Jan. Okay. Now tell me. On 31st of Jan, how much will be the price? Will I know in advance? Is it 1000 rupees? Many people confuse. On 31st Jan, it is going to be 1000 rupees. No, 1000 rupees for you to buy. For you to sell, that price we don't know. To compute the profit, there always be two prices. One buy price, other sell price. Your buy price is fixed for you. Your sell price you don't know because you have to sell in the market. You enter into contract to buy only. That means you will, if you execute, you get one share, you pay 1000 rupees. But at what price you sell, that you don't know. That you will come to know only on 31st of Jan. So 31st of Jan, yes, you make a payment of 1000 rupees, you get the share, you sell in the market, you get profit. Let's say 1050 rupees. You sell in the market. You get 50 rupees profit. Settlement by delivery basis. Okay, let me write it. On 31st of Jan, execute the contracts. Execute the contracts. Means what? Pay 1000 rupees and get one share and get one Infosys share. Sell in the market. Sell that share in markets. Let's say at market price, prevailing at that point in time, at market price of 1050. So you get a profit of 50 rupees. You make a profit of 50 rupees. So this is called as settlement by delivery basis. Settlement by delivery basis. Settlement by delivery basis. 90% of the transaction practically settlement by delivery will not happen, but the choice will be given to you. If you don't do square off, automatic delivery will be there. You have to make the payment, shares you have to acquire it. You don't have any choice. But there is an option of square off. Let me tell you what is square off. On 31st of Jan, you would like to cancel the agreement. You know how you cancel the agreement? You sign a contract, one more contract. What price? You enter into agreement to sell. You enter into agreement to sell at. Can you tell me at what price? You enter into an agreement to sell at what price? Not 1000 rupees. 1000 rupees at point in time. And today on 31st of Jan, price is at 1050, right? You observed market price. So today you sign into an agreement into sell at 1050 on delivery on what date? Selling on what date? Today itself. To be settled on 31st of Jan. To be settled on 31st of Jan. Okay, now you tell me. Please tell me this. Previous agreement, when did I enter? Previous agreement, when did I enter? Agreement to buy, when did I enter? On 1st of Jan. Correct? On 1st of Jan. And this agreement, when did I enter? This agreement, when did I enter? On 31st of Jan. Date of entry may be different, but what date both are going to be settled? This expiry date for both of this contract. The settlement date for both of this contract is same, right? 1st of Jan I'm entering, 31st of Jan I'm entering, agreement to buy, agreement to sell, but both are getting expired. Both settlement dates are 31st of Jan. So if you think from my position point of view, I have an agreement to buy which expires today. I have an agreement to sell which expires today. Effectively, I don't have to buy, I don't have to sell. That is how the net settlement happens. That effectively the contract is cancelled. Effectively, contract is cancelled. Effectively, contracts cancelled. And that is what is called as square off. Hope you understood the meaning of square off. Square off means net settlement. Because you cannot cancel the contract by mutual consent because other party I don't know. But we do a mechanism of square off such a way in reality, in effectively, the contract is cancelled. And that is what is called a square off. And therefore, differential amount. You have to buy at 1000, sell at 1050. So, differential amount 50 rupees, you will receive it. 1050 minus 50, 1050, 50 rupees will come to your pocket. I'm getting one question. Delivery to that person and sale by that person can happen on 31st January itself. Yes, that's what should happen. Delivery and sale should happen on 31st of Jan. But because there is one buy contract and sell contract, two contracts open, effectively they will cancel each other. They will cancel each other. That's called as square off settlement. So if I talk about square off, you don't have to bring all these concepts in. What is a very important, simple thing? In spot market, I buy, I sell. Very simple. Difference is my profit. In spot market, if I take a short position, which is not so simple, but if I take, later I will buy, and difference is my profit. But in case of future contract, earlier I enter into future buy. Now when I want to cancel, I'll do future sell. That's called a square off. Effectively, I am selling my contract. This is, so you can say earlier it was future buy, right? Earlier it was future buy. We have written. Now when you enter into contract, it is future sell. It is future sell. Opposite. That basically. Future sell. Future sell. Okay. Now answer me this question. Now answer this question. Settlement by delivery basis. Settlement by delivery basis. Can it happen before settlement date? If you know other person, you could have talked to him, you could have requested him. But here, remember, it happens through stock exchange. You don't know the other party with whom you entered into. So, is it possible to settle at an earlier date than original date? Answer is absolutely no. Between two parties, it would be possible. In forward contract, it might be possible. You can speak to them. But in future contract, settlement by delivery before expiry date cannot happen. Settlement by delivery. Settlement before delivery. Settlement before expiry. Sorry. Settlement before expiry. By delivery basis, not possible. If it is delivery basis, not possible. You have to wait. Not possible. Okay. Now you think, is square off possible? Settlement before expiry? Is square off possible? Yes. Why is square off possible? How can you cancel the agreement? Because you are not really cancelling the agreement. You are giving the effect by entering into opposite contract. That opposite contract you can enter anytime. So, by net basis, possible. By possible, because you can do square off. You can do square off. So basically, let's say 2 days before whatever the market price, at that price I will sell. I will sell. So my earlier was future buy contract, now future sell contract. That's all. My contract is in effect cancelled, in effect squared off, closed. Okay, same example I'll take. 1st of Jan, the price was 1000 rupees where I entered into future buy. On let's say 28th of Jan, market was let's say 1020 rupees. It's going to be future sell. On that day, the price was 1020 future sell. That is, I basically squared off my position. Squared off my position. Okay, now you please tell me. Now you please tell me. The differential amounts is your profit 20 rupees net settlement, net 20 rupees. When it should come to you? When this 20 rupees should come to your account? Will it come on 28th of Jan or should it come later? It's an interesting question, interesting answer. Okay, okay. Now, on 1st of Jan, please tell me how much you are paying. Try to answer this. Important. On 1st of Jan, how much you paid? Nothing, right? Because you have just signed a contract. When are you going to pay? On 31st of Jan. So 1st of Jan, the settlement date is going to be 31st of Jan, month end. Okay, now you tell me, on 28th of Jan, how much you would have received? You enter into future sell contract. How much you would have received? Do you think 1020 you will receive? Nil, right? Same logic applies. Same logic applies. This also settlement date is 31st of Jan. So effectively, 20 rupees should be received on 31st Jan only. Receivable on expiry date only, because both are contract to be settled on 31st of Jan. So receivable on expiry. Receivable on expiry. That is correct? Okay. Here comes an interesting question. Listen to me carefully. Interesting answer. The 20 rupees, you don't have to wait till 31st of Jan. Even in the previous example, this 50 rupees, difference 50 rupees, you don't have to wait till expiry. Why? Because we follow MTM settlement, mark to market settlement. It is nothing but daily settlement. Daily settlement means what? See, 1st of Jan was 1000 rupees. Suppose 2nd of Jan, suppose the price was, let's say, 1005 rupees. 1005 rupees. But you on 2nd of Jan, you did not do any transaction. You kept quiet. But 5 rupees will come to your account. Difference between previous day price and today price will keep coming to your account, or if it is a loss, it will be taken out from your account. So by the end of 28th Jan, 20 rupees effectively would have come to you, and that is what is called as margin money, margin adjustment. I'll tell you what is that adjustment. So due to mark to market settlement, you really don't wait till expiry for you to receive the money because of MTM settlement, mark to market settlement. Okay, to understand that little bit in detail, let me talk about margin money. Margin money. Okay, I asked the question again. When you entered into a contract on 1st of Jan, how much you paid? You said 0, right? Correct, absolutely correct. If now you imagine like this, there is no square of settlement. Just for time being, there is no square of settlement. If it is settlement by delivery basis, how much money you should have minimum For you to execute this contract, 1,000 rupees. You should have minimum 1,000 rupees to execute the contract if you want to do settlement by delivery basis. But you cannot be asked to pay 1,000 rupees on 1st of Jan. On 1st of Jan, if they say pay 1,000 rupees, what will you tell? I don't want future contract. I'll go to spot only. What is the point in coming to agreement? I am not paying full. I don't have cash. If I had cash, I would have gone to spot market. Why am coming to future market? Make sense? 1,000 rupees will not be asked. But as you approach the 31st of Jan, then they will ask you higher margin. Okay, I'll come to it later. Okay. And first of all, on 31st of Jan, you are supposed to pay 1,000 rupees. If you did not come, if you don't come, obviously the contract is going to be failed, bounced, or contract is going to be not executed. That is going to be a problem. And that is always there, especially in our Indian mindsets, that we don't follow things on time. That is, we sign agreement, we tell lot of things, but when it comes to execution, we don't do it. That's why future contracts are scary, because just signing a contract, no, everybody signs a contract, different signature, you put money on the state of settlement, you run away. So as a safety purpose, margin money will be collected. That is called as initial margin. Initial margin. That is like a deposit. When you enter into contract, deposits at the time of entering into contract. At the time of entering into contract. And you get back this. You get back this when you exit. It will be returned when you exit, or when you do square off, when you exit. When you exit, when you execute, or when you square off. Okay, return when you exit. So you deposit initially 1 lakh, you get back 1 lakh. Okay, so it will be some percentage of contract value. It will be some percentage. I told you, it will not be 1,000 rupees. If it is 1,000 rupees, there is no point in coming to future. It's not called derivative at all, actually. So it will be some percentage of contract value. Some percentage of contract value. In mark to market settlement, without paying 1,000 rupees on 1st of Jan, 5 rupees will be received on 2nd of Jan. You are right. You will receive 5 rupees on 2nd of Jan for difference in price. But you pay something on 1st of Jan. What do you pay something on 1st of Jan? I'm just telling you now. What is that? Initial margin. How much is that? Maybe let's say 10% of contract value. 1,000 rupee was there. 10%. You pay around 100 rupees. But you will get back 100 rupees next day, or whenever you close the account. You close the position. You square off. Okay. Initial margin. Okay. The difference amount what you get is called as variation margin. Another one we have variation margin. Variation margin, daily settlement, differential amount due to MTM settlement. Difference in daily price, difference in daily price due to MTM settlement. Due to MTM settlement. Then we have maintenance margin. Maintenance margin. Maintenance margin. That is minimum balance to be maintained. Minimum variation to be maintained. Minimum margin, okay. Minimum margin to be maintained. Minimum margin to be maintained. Like a minimum bank balance. So let's say initial margin is 1 lakh. You deposit initially 1 lakh. Maintenance margin, you have to maintain this margin at any point in time. Let's say 80,000. You cannot go below 80,000 like minimum bank balance. Now, because of everyday settlement, I think market is going against you. Variation margin you are having on that day, let's say minus 35,000. Now, can you tell me what will be your actual margin balance? 1 lakh minus 35,000, it will come to 65,000, right? 65,000. But what is the balance you have to maintain? 80,000. You are feeling the shortage. So when you have the shortage, you have to pay it back. You have to get some money and give it to broker to maintain the margin. How much money you have to give it to broker? How much money do you think you have to give it to broker to maintain 80,000 balance? 1 lakh was your balance. 35,000 was taken out. It became 65,000. And your balance is now only, you're supposed to make 80,000. 15,000 you're supposed to put it back. But it will not be like that. Because next day, again, if there is a loss, again, broker has to collect money from you. Don't you think broker has a better work than keep collecting the money from you? So if balance goes below maintenance margin, you have to bring it back to initial margin. So when it goes to 65,000, you have to bring it back to 1 lakh, not 80,000. Okay, that difference is called as call money or margin call. Call money. This is if balance goes below minimum, if margin goes below maintenance margin, below maintenance margin. If margin goes below maintenance margin, then amount to be paid, difference between what? Not the maintenance margin. So in that way, it is not same as your bank balance. You have to bring it back to original margin. So difference is going to be initial margin minus maintenance margin. Initial margin minus maintenance margin. Initial margin minus maintenance margin. Okay, hope you got it. Okay, I'll show you practically. Give me a second. What are the types of future depending on its underlying asset? We have stock futures. Underlying asset is shares of a particular company, like shares of Infosys, shares of Reliance, shares of TCS, like that. We have index futures also. Index futures like Nifty, Bank Nifty, Sensex, things like that. Currency futures also we have. Underlying asset is like USD INR, We have commodity future also, like oil future, gold future, commodities, copper, like that. Underlying asset, we have different things. Interest rate, even we have interest rate futures. Underlying asset can be interest rate also. We are going to discuss that. Okay, so what are the main advantages of futures? If you can say leverage. What do you mean by leverage? If you have 1 lakh, if you go to spot market, you have to spend the entire 1 lakh. But in future market, you don't have to spend the entire 1 lakh. Why? Because you have to give only lesser amount, like 10% of the contract value. So your rate of return will increase. Good also, bad also. If a thing happens, see, for example, if contract value was 1000 rupees and it becomes, let's say, 1,20,000 when you sell. So how much profit you made in spot market? 20,000 profit. What is return on investment? 20,000, 1 lakh, 20% your return on investment. Simple, 20% profit you made. But if you come to futures, you make a profit of 20,000, but how much will you invest? You don't pay entire 1 lakh, you pay only initial margin money, that will come back. So what is your investment in the sense? Maybe if it is a 10% of contract value, 1 lakh 10% means you paid 10,000. So you invested 10,000, you get 20,000 profit, 200% return. If it is a loss, gone case. That amount is lost. Right? So that's what is called as leverage. Hope you understand. Your rate of return will multiply. Good if things happens well, bad if things goes against you. That is why derivative segment you have to be very careful. Ease of shorting. You know, in spot market, shorting is not so easy. In intraday, for individuals, it is possible. What is intraday? Morning I can short, evening I have to buy it back. I have to close by the end of the day. If I want to buy tomorrow, I cannot do it. Individually, I cannot do it. Institutions will do. What do you call? Stock lending mechanism. Institutions can borrow shares, they can do shorting. But individual people, not so easy to short in spot market. But in future market, I can easily short. Why? It's after all signing a contract. I don't have to have shares. It's signing a contract. So when the date comes, if I want to sell, I can buy somewhere and sell it. Or I can do square off, which is cancelling the contract. So without having the shares, I can sell easily in future market. So shorting is easy in futures. Flexibility in three purposes. Three purpose, we are going to discuss that. Speculation, arbitrage, and hedging. Future instrument can be used. I'll teach you that. And index future is one more advantage. You know what is Nifty 50? It's an index. Can you buy a Nifty 50 index? The answer is no. I cannot buy that because it's a representative to tell what happened in the market. I cannot buy Nifty 50. If I want to buy, I should buy all the shares of 50 companies in same proportion. That will require crores of rupees. But I can enter into index future because index future will vary because of index only. And therefore, the value of the value of index what you trade will be same as index future. So easy to trade in index future because index cannot be delivered, and index future cannot happen settlement by delivery basis. You cannot deliver index. Index future has to be settled by net basis, square off. Okay, a difference between forwards and futures. Trading over the counter is forward between two people. Future happens through stock exchange. Forwards are individually tailored between two people. No, you can enter into any day you want. You can execute as any amount you can mention, and any date can be expiry date. Futures are standards. Date of settlement, any date. Futures, standard expiry date. In Indian context, last Thursday of every month, and we will have only 3 live contracts: current month, next month, subsequent month. At any time, we will have only 3 contracts. That is in Indian context. Transaction cost, forwards between two individuals. Futures, standard cost. These stamp duty charges, STT charges, all will be fixed because everything happens on a systematic basis as per stock exchanges. Mark to market, forward contract don't apply. In futures, it applies. Margin money in forward don't apply. In future, it applies. This chart must be there in the material. Maybe in your summary chart, you don't have to write it. You can just have a glance, and if you have any questions, you can ask. Okay. I hope no difference. Now let me just compare quickly between spot market, future market. Spot market means you do trade in shares. You have to make the payment, cash and carry. Future market means what? You know by now. You don't make the payment in cash except for margin money. It is signing contracts. Spot market, spot price. Future market will have future price. Volume. In spot market, it can be any number. In future market, it is lot size. And price quoted on in spot market for today's settlement. But in future market, it is not for today's settlement. It is a price quoted today, but for settlement at a later date. Price known today, but it will not be paid today in futures. It will be paid later. Settlement in spot market has to be by delivery basis. In future, it can be cash or delivery, but mostly cash basis. Square off. Index trading in spot market not possible, future possible. Yeah. So these are the difference between spot market and future market. In the exam, they may not ask you a question like this, but understanding this will help you understand futures better. So just glance through this point and let me know if I should explain any point particularly here. Okay. Okay. Before I go to the practical aspect, I just discuss one more important point. Few minutes it will take, and then we'll go further. Okay. So I told you just now, spot market will have spot price, future market will have future price. Why are they different? When I show you practically, you'll understand better. But anyway, spot price is for today's settlement. Future price is for what settlement? Is it going to be settled today itself? Obviously, it's going to be later, right? It's going to be settled at a later point in time. So what is common between spot price, future price? Both are about same instrument. Like if I say Infosys spot price, it's about Infosys shares. If I say future price of Infosys, it's about Infosys shares. That is common. But what is the difference? In the timing of settlement. In spot price, it is today's settlement. In future price, it is settlement at a later date. So only difference is due to the time. The difference between the spot price, future price is technically because of difference in timing. Then what should the price differential should represent? Time value of money, correct? The difference between spot price and future price should reflect time value of money, and that is also called as cost to carry, because you're not paying today, you're going to pay it later. So difference in the prices is because of timing in settlement. So difference in prices should be because of time value of money. So theoretically, future price is spot price adjusted for time value of money plus, not literally adjusted. You can say simple interest, compound interest, etc. But effectively it is time value of money. So you can just write down spot price and future price, spot price and future price, spot price and future price. The difference should reflect, point below, the difference should reflect, the difference should reflect time value of money. The difference should reflect time value of money. The difference should reflect time value of money due to due to due to difference in adjustments, due to difference in adjustments, due to difference in adjustments, due to difference in adjustments. So you can say, you can write this theoretically, future price is spot price plus time value of money. Future price is spot price plus time value of money, plus time value of money, plus time value of money. Okay. Now this can be in the examination, you can say simple interest. Simple interest means what? Future equal to spot price plus spot price into rate of interest into term. T maybe by 365, T by 12, number of months, anything. Time period. T, I'll just say T. Time period. If it is compound interest, how do you calculate future value? Spot is present value into 1 plus R to the power of T, monthly compounding, daily compounding, etc. If it is continuous compounding, F equals to spot into, remember the formula in the basics we discussed, continuous compounding, spot multiplied by e to the power of R into T, RT, e to the power of RT. R is rate of interest, T is time period, and exam answer will be very close. You know that basics. Answer will be very close. Answer will be close. But in exam point of view, which one would you recommend? Would you recommend continuous compounding? I would say do it only if E value information is available. Of course, if they tell you, you should do it. If question is silent, do it only if, apply if E value is available. E is available. Apply only if E value is available. If they give you that e to the power of something is equal to so much, then only use continuous compounding. Otherwise, you can use simple interest or you can use compound interest. Both are fine. Okay. Hope you have taken down. Okay. Now, let's understand changes in price. Okay. For the time being, let's say today is, let's say 1st of Jan and expiry is, let's say 31st of Jan. And spot price is, let's say, 1000 rupees. Spot price 1000 rupees. Future price, it should be more than 1000 rupees. That is for sure. Now this 1000 rupees, more than 1000 rupees excess. Let's say it's 1020 rupees. Now 20 rupees is representing for how many days time to expiry? Can you tell me? You know that future price is spot price plus time value of money, right? So spot price is 1000. Future price is 20 rupees. So the 20 rupees representing how many times value of money? What time value of money? For 30 days, right? Because from 1st of Jan to 30th of Jan means 30 days. Okay. Next day, suppose assume spot price remains same 1000 rupees. Assuming remains same 1000 rupees. Now can you please tell me what will happen to future price? Will it remain same? Will it increase? Will it decrease? Spot price, I know changes, but assume spot price next day remaining same. That is on 2nd of Jan. Next day. Now you tell me the spot price remaining same. Next day, what will happen to future price? It will remain same, it will increase, it will decrease. One of the three things has to happen. What do you think? Okay. Now, 1000 rupees is for today's settlement. Now, future price. Now, can you tell me after how many days it is going to be settled? After how many days it is going to be settled? On 2nd of Jan. After 29 days? Now, previous day, after how many days it was settled? After 30 days. So, basically, number of days reduced, right? 29 days. Hope you understand now what will happen. This will decrease. Let's say it comes to 1018 rupees. Are you understanding why? Because time to expiry getting reduced. You understand the difference should reflect time value of money. As the time progress, the time value should reduce because number of days getting less, less and less. Try to imagine that, my dear friends. Spot price, future price is difference because of their settlement time. Spot price, immediate settlement, future price, later date settlement. As the time gap is more, time value is more. As the time gap is less, time value is less. So as the time progress, the expiry date don't change. Expiry date remains same. Expiry date remains same. As a result, the gap will keep less, less and less. In other words, when you wrote the formula here, right? R T, T everywhere, the T represents time remaining expiry, remaining time to expiry, remaining time to expiry. Always keep it in mind. So if you enter the contract 2 months back and we have only 2 days left, what number should take? I should not take 2 months as T. I should take only 2 days remaining time to expiry, because that is what is reflected in future price, remaining time from today till settlement date. Past does not matter. Hope you are clear. Okay. So if you look at the chart, it actually looks like this. Assume the spot price remaining same. As the time progress, you see the gap getting reduced because the gap represents time value of money. Getting the point? As the time progress, the gap keep getting reduces, so time value of money getting reduced. On the expiry date, spot price and future price becomes same. We'll write the sentence, don't worry. So for the higher expiry date, it will be higher future price. Actual spot price will happen like this. You see, everyday spot price will not remain same. It changes. But the gap you see between the two things, the upper one is the future price. So the gap between these two will always keep reducing it. Anyway, this, you don't have to write it down. I just showed you for your reference. But both cases, look at the last date. On expiry date, spot price, future price will become same. Let's write down some points. You write down this. Future price is mostly greater than spot price. Exceptions are there. I'll come to it later. But you write down this. Future price is mostly greater than spot price. Future price is mostly greater than spot price. Why? Because it is settled at a later date. When it is going to be settled at a later date, there'll always be time value of money. And longer the expiry date, longer the future price. Why? Because higher the time gap, higher the time value of money. So longer the expiry date, higher the future price. As the time progress, the gap reduces, because as the time progress, as we move to next day, the time value of money keeps getting reduced. So gap also will getting reduced. Gap between future and spot price gets reduced, because time to expiry will keep getting reduced. When the time reduces, uh, when the remaining time reduces, value also reduces. Even if the spot price remains same, future price reduce. I just told you why. Because of time value of money. Even if the spot price remains same, future price will reduce. Okay. This point is very important. Last point. Quite a few things to explain. You write down, I'll explain. On spot price, on expiry date, spot price and future price both will coincide. Both will coincide. Last point is very important. I'll explain. Hope you've written till here. Okay, fine. Good. Now listen to me. What is the future price spot price difference? I told you, difference due to timing settlement. If 30 days away, that should be reflected in the difference. If 29 days away, that should be reflected in the difference. If 15 days away, 14 days away, 13 days away, 10 days away, 9 days away, and today is the settlement date. So on the settlement date, imagine spot price is for which date settlement? Today settlement. Future price is for what day settlement? Today settlement. So on expiry date, future price spot price should be absolutely equal, right? That's what I told you. On expiry date, future price and spot price should coincide. But in reality, will it happen, sir? It will not happen exactly. Why, sir? At 9:30, if you tell spot price immediate, but future price is going to be on the day end. So it will be 4 5 hours time value. Very negligible, but still small time value is there. So, but on 3:30, when the market closes, spot price, future price, both becomes same. We can tell lot of things about this. I'll try to tell few sentences. Maybe it looks little bit philosophical, but I would like to share my thoughts. Usually, I don't celebrate my birthday. And usually, what? I don't celebrate my birthday because every day, every time a birthday comes, this concept hits me. What concept? You have time to expiry. Today is the spot price. You have an expiry date. Everybody has an expiry date. We don't know that. So, as and when you move 1 year further, that means you're getting closer to your expiry, right? When you're closer to expiry, how can you celebrate that? That means your time left getting reduced. Anyway, so that's why the time value of money getting reduced, I think, in my opinion, birthday are not for celebrations. Great people birthday will celebrate even after death. People who are alive, I don't believe in that. And you would have heard uh, Steve Jobs, one of the famous quotations. He told, "Every day I told myself, today is my last day, and one day it becomes true. Every day I live as if it is my last day, and one day it becomes true." In the sense, what do you mean by this? We always tell, right? Tomorrow I will die. Tomorrow I will die. One day you will definitely die. So today's tomorrow is tomorrow's today. Okay. Let me try to tell in slightly uh, lighter manner. Your examination, as an example, we can take it. You know, exams, what do you tell? Oh, we have 3 months away. No, 6 months away. Then you tell, okay, 3 months away. So how do you plan? You, let's say, for example, you have 80 days left. You have 40 chapters to cover. What do you tell? Very simple, sir. Two chapters. I mean, one chapter, 2 days. 80 by 40. You do calculation, costing. 40 days over. Then no reaction. What will happen? Oh, 40 days. Oh, 40 days by 40 chapter. One day, one chapter I'll read. 20 days over, no improvement. Oh, for 20 by 40. That time I was supposed to cover 2 days for a chapter. Now I have one day, two chapters. You know how to revise. And 5 days over, only remaining 5 days pending. Let's say 5 days, you have to cover 40 chapters. Still, you know how to manage. A day, you divide this into 8 sessions after getting up, before brush, after brush, before breakfast, after breakfast, before washing hands. You know how to divide the days. You are absolutely great in planning. And 3 days over, only 2 days left for examination. What do you tell? No problem. Next attempt is there. But that exam, you still have to write, right? So basically, it means what? You had 6 months for exams, then 4 months for exams, 2 months for exam. Tomorrow is exam. Today is the exam. As the time progress, the gap getting reduced. I hope you understand. Okay, one more smaller philosophical way I would like to put it across, then we'll move further. Imagine spot price is your position today, your present situation, and your dreams are your futures price. So what is difference between spot price, future price? Time value, interest, right? So what is the difference between your spot and your future? Interest. So everybody's spot listening here is same. Each one of your present situation is same. How your future will be different? Because of your interest. So interest is the differentiating factor between your spot price and your future price. Anyway, again, just to, if I keep the future as dreams, spot price as today, there'll always be time gap between your present and your dreams, and one day your dreams will coincide with your present life. One day your future will coincide with your spot, where tomorrow does not exist. Today also today, tomorrow also today. What is that is called as expiry date. You know, on your expiry date, there is no tomorrow. That itself is the end of settlement. Anyway, uh, you can say it's a future. You can say it's life philosophy. According to me, things are not different. If you really compare, you will definitely see learning everywhere. Okay, morning sessions. You are already bored of listening to my lecturers, some lectures and tortures, and that too, if I had philosophies, I can understand your situation. Okay, and in my opinion, all CA students are philosophers only. Without knowing philosophy, CA, you cannot pass CA, because you have to struggle so much. You have to face so many situations. You have to do so many multitasking. You have to be ignorant. You should not respond to various factors revolving around you. So in that way, in olden days, people used to go to forest to do penance where God will come. I think now those people are called as CA students, and that God is a CA degree. Anyway, so let's go further. One small point. Impact of, okay, this is called as fair value future. We'll come to it. Impact of dividend. Just one small point, then we look at practical aspects. Impact of dividend. Okay, so we have spot price here, and future price is for a later date settlement. The spot price and the future price, the difference is time value of money, it, interest. Time value of money or interest. Okay, now you think, if between the spot price, that is date of transaction, and expiry dates, the difference between those two dates, if you are expecting any dividends, now you tell me, when a dividend is likely to be paid, what will happen to the future price? Theoretically, what should happen? The future price should fall or future price should be high. The future price should reduce, right? Because X dividend concepts. So any dividend between spot price and future price. So dividends expected, because this is not past, dividend expected between the date of transaction and expiry date is going to have a negative impact. In the sense, it will reduce the price. It will reduce the price because X dividend price. Spot price today is come dividend, but when the expiry date comes after payment of dividend, it will be reducing. It will reduce price. It will reduce price. Okay. So what is a fair future value formula? I told you. If I take simple interest, you can say spot price plus interest minus dividends amount. If it is compound interest, then future value is spot price minus dividend. But remember one thing, spot price is today price. Dividend will happen later. Then what should happen here? Can you tell me? I should not reduce dividend fully. What I should reduce? Present value of dividends. Do you understand? Dividend will happen later point in time, right? Maybe after 10 days, after 1 month, but spot price today. So if I have to bring it to today value, I should do present value of dividend. When I subtract, I get X dividend. Then you multiply it by whatever to the power of, this is future value, present value into 1 plus R to the power of T. Similarly, if it is compounding interest, then spot price minus present value of dividend into e to the power of RT. E to the power of RT. And there's one more interesting thing can happen. Sometimes they give information in percentage terms. They tell dividend yield. Dividend yield is percentage terms. Now, can you tell me, if dividend yield is percentage terms, how do you convert it to per share basis? On what will you apply to compute dividend per share? Dividend yield percentage, they said. On what will you apply to compute dividend per share? Not on face value. Dividend percentage, you apply it on face value. Dividend yield is always applicable on spot price or market price. Correct? Now, interest is also applied on spot price. Dividend yield is applied on spot price. So, instead of this, we can use regular formula, and the rate of interest I can do it on net basis. interest, let's say 10% I add, dividend yield, let's say 2% I subtract. So effectively, I can do net 8%. Answer is going to be same. So sometimes you see that kind of problem as well. So let me quickly write down. So if dividend yield is percentage, that one, future value equals if it is simple interest, spot plus net interest. If it is compound interest, spot into 1 plus r to the power of t, where r is rate of interest minus rate of risk-free interest, rate of interest minus dividend yield percentage. Or if it is compound interest, it is spot into 1 plus r to the power of 1 plus r to the power of not 1 plus r, sorry, e to the power of rt, or people write like this, r minus d into t. R represents a rate of interest and d represents dividend yield. D represents dividend yield. Basically net amount we are doing, and t always represents, mind it, remaining time to expiry. Remaining time means date of transaction till expiry date. Remaining time to expiry. Date of transaction till expiry date. Remaining time to expiry. So this is called as fair value of futures. This is called as fair value of futures. But if actual value is different, then there exists arbitrage opportunity. We discuss about the arbitrage strategies later. So difference between, if fair value difference, this also called as theoretical minimum price, whatever value, if fair value is different from actual future price, okay, I don't have space, I'll tell you to write it. If fair value is different from actual future price, if fair value is different from actual future price, if fair value is different from actual future price, if fair value is different from actual future price, then there exists, arbitrage opportunity. Then there exists arbitrage opportunity. Then there exists arbitrage opportunity. Then there exists arbitrage opportunity. If fair value is different from actual future price, if fair value is different from actual future price, there exists arbitrage opportunity. There exists arbitrage opportunity. Okay, so hope you have understood basics of futures. Settlement mechanism, terminology is involved, and fair value of future, impact of dividends. Okay, good. Okay. Okay. Please tell me if you are able to see nscindia.com websites. You can, right? Okay, very good. Okay. Okay, so let's look at, let's say, Reliance Industries. Various types of prices are there. Let's see, what is the yesterday price? 2089. 2089. Let's say that is today price. So if you want to buy it now, cash and carry, spot market, you pay 2089 rupees, you get one share. Very simple. Now let's say uh, we have one more segment called as derivatives. And let me look at option contracts. They will show you everything. Okay. Stock futures. Okay. Stock futures. Can you see expiry date? We only have three things: 29 July 2021, 26th August 2021, 30th September 2021. These are the last Thursday of these months. In the futures, we will have a standard expiry dates, and that to India, we are having 3 months at any time live contracts. Today month, this month, which is 29 July, June is over actually. June expiry date is over. So July month is current month, August is next, September is next. So three series are alive. And what is the price? Let's look at the price. 2100. Can you see the number? 2100, right? What was spot price? Remember? 2089. And this is 2001. Where is that number? This is 2100. Do you understand, my dear friends? 2089 is for today's settlement. 2100 is month end settlement. So why you are paying extra 10 rupees for time value of money for 1 month? Now you look at the next one. Next one is August month expiry 2107, because one more month is there. In the sense, totally 2 months. Higher the time gap, higher the time value of money. Cost to carry, people say it. And 2116, time value of money. This is after 2 more months, August, September, 3 months later. So you're having even more higher amount. I hope you're able to make sense. Around 9-10 rupees difference every month you move forward. Higher the expiry date, longer the expiry date, higher will be the future price. Okay. I'll show you the margin also. Let's go to, okay, zero the margin calculator. I'll talk about margin, but before that, any questions you want to ask about the spot price, future price? SLB, stock clearing mechanism, no information is there. Anyway, okay, there are some information. Fine, that does not matter. Let's look at derivatives. Okay, I'm getting no questions. Good. Then I'll go to zero the calculator. Zero the brokerage, not brokerage calculator. Zero the margin calculator. Okay. If you want to buy one lot of Infosys shares, let's say how much you have to pay. The number we already computed, 2100 something, right? That was the future price. So I'll select futures, symbol Reliance, 29th July 2021. Quantity 250, you understand? 250 quantity, because that is called as lot size. Reliance has to be multiple of 250, 500, 750,000 like that. In spot market, you can buy any shares. In future markets, it has to be lot size. So buy, I'll just say add span. Okay, span is a thing therefore used for initial margin, 97,445. Exposure margin 18,000. You need to have total margin of 1,15,830. 1,15,830. But what is the contract value? Can we calculate 250 into 2100, because currently the price is at 2100. So 250 into 2100, 5 lakh 25,000, right? That is the amount, 5 lakh 25,000 that you have to contract value. But 1 lakh 15,830, so 1 lakh out of 5 lakh, approximately 20% only. So if you have to go to spot market, you have to invest 5 lakhs to get the 250 shares. But in future market, you can just invest 1 lakh and you get 250 shares. You don't get the shares today, but you are trying to find out settlement on net basis. If you want to settle on delivery basis, you can. On the expiry date, 29 July, you make a payment of this contract value, then you get the amount, you get the shares to your demat account. But usually people will do a square off, they do settle on net basis. I hope this practical aspect you are able to get as well. Any questions? Exposure margin is main. I told you that variation margin. What could happen next day? That also they take it as an advance, like a margin money. So basically, your initial margin money will be span exposure plus expand plus exposure. That becomes the initial margin. Then exposure margin changes every day. What is an exposure margin? That is nothing but your maintenance variation margin. Every day, the exposure margin changes, the variation margin, the mark to market settlement. They're just given the breakup of the two amounts. Please explain MTM. MTM stands for mark to market. Basically, it means the amount you are supposed to receive on expiry date, logically, because only on that day cash flow will take place. But practically, you don't have to wait till expiry date. On a everyday difference in the closing prices, it will happen. See, for example, Reliance share price is 2100 future price. You enter into future buy. You took a long position basically. And tomorrow it becomes 2102, 2 rupees increase. But you have not done any transaction, you just kept quiet. But even then, your margin money gets adjusted for the changes in the price. If it is in your favor, the margin money will get added, the exposure margin will get adjusted. Or if it is against you, the balance money from your account will get subtracted. So when you're whatever the money you are having in the margin or amount available to you, if it is in your favor, amount available to you will increase. Your margin balance basically will increase because money will come from other party and given to you. If it is going against you, it will be taken out from your margin balance account, and that's what is MTM. On a daily basis, depending on the price fluctuations, your margin will get added. If it is in your favor, margin gets subtracted. If it is against you, that's MTM settlement, daily settlement. Okay, hope you got it. Any other questions? And always remember, in futures, there will be two parties. They are not aware of each other. One party will take a long position. So if you do future buy, you are set to have a long position, and there will be another person who is having a short position because he would have entered into future sell. Okay, let's go to problems then. Okay, fine. Hope you got this question. Is it exam question or something? Yes, January 2021 exam question, but very practical question also. Let's read. Oh, okay. It's not shared. 1 second. Thank you for reminding. Okay, now I think PPT is visible. Yes, thank you. The price of the March Nifty futures contract on a particular day was 9170. That talking about index futures. Practically, we traders usually do only index trading because stock trading liquidity is always a problem. Not many contracts will be there. So we usually trade in Nifty. I mean, if for the liquidity part aspect. The price of the March Nifty future. Okay, when I say March Nifty future, when is going to be the expiry date? March end. In India, it's last Thursday, but that you don't have to apply in exams. March end, you have to understand. March future means expiring in March end. The minimum trading lot on Nifty future is 50. That you know lot size. Actually, it is 50 now. The initial margin is 8 and maintenance margin is 6. I think 8%. When I say 8%. Index closed on the following levels on the next 5 days 1, 2, 3, 4, 5. You require to calculate mark to market cash flows and daily closing balance on account of investor who had taken a long position at 9170 and investor who has taken a short position opposite person 9170 net profit or loss on each of the contracts. Very simple problem, but practical application problem. This should give you a good confidence regarding uh, futures mechanism, how the transaction works. Okay, so let's first calculate what is initial margin, what is maintenance margin. Let's calculate that. Working notes. Initial margin, what they're given, 8% of contract value. They said 8%, it means 8% of contract value. 8% of contract value. Actually, practically now SEBI has increased the margin. Now I think it's around 20% of contract value to come. It differs from stock to stock, of course. A stock which is having higher risk will have higher contract value. And if it is hedged position, the margin benefit will be there. That you don't worry. So what is the contract value? 9170 is the price and number of unit is 50. So 8% of 9170 into 50. Contract value 8%. So contract value 4,58,500. 8% of that 36,680. Okay, maintenance margin, the minimum balance you have to maintain 6%. So 6% of contract value, 6% of 4,58,500. 27,510. 27,510. So if you think of a stock exchange or for a broker, the person who go long, the person who will go into FB, future buy, he will have to deposit margin of 36,680. The person who goes short, future sell, he also should give deposit to stock exchange, SC, stock exchange 36,680. Both of them have to give their money. Now, this is a problem purely on speculation, because there is no risk you are covering and we are not doing any arbitrage strategy here. You have taken a long position. If market goes in favor, you make profit, loss. Same thing applicable for others. Okay, so let's they've asked what is there, mark to market cash flows and daily closing balance on account of investor taken a position at 9170 and other person. So this will beautifully tell you about how MTM works. Hope you have taken down here. Let's go for the next one. Investor taken a long position at 9170. Investor who has taken long position at 9170. You understand the meaning of long position? You are having a view market price will go up. If it does go up, you make profit. If it goes against you, you make loss. So working note, hope you have taken down. Now we'll do this. So we have to account for every day now. So what was your everyday balance or day, date, whatever it is, what we have? Day, okay, day 1, day 2, like that, every day. Then whatever the changes, that's called as maintenance margin, variation margin actually. The changes in price, that is called as the maintenance margin, you can say. Then margin balance. You know, sometimes the margin balance can go below maintenance margin. In that case, the money has to be put in by the investor. Do you know what is it called as? In case the margin balance goes below maintenance margin, he has to put in the balance shortage to make it till initial margin. It's called as call money. It comes in some cases. So let's have one column for call money. and revised margin balance. Revised margin balance, because after he put in the money, whatever is the revised amount. Okay, day one initial margin, whatever day 0 I'll start with. Initial margin was 36,680. Call money nothing. First day itself no call money. Revised margin 36,680. Okay, this is basic actual starting point. Okay, let's start from day one. What is the price has become? 9380. 9380. So 9170 became 9380. 9380 minus 9170 multiplied by Nifty lot 50. He has entered into one contract only, I think. So only 50 units. If he entered into two contracts, 100, 50 into 2. So what is the balance? Change in price, actually called as maintenance margin. 9380 minus 9170 into 50. 10,500, right? 10,500. Okay. Now you please tell me, 10,500, is it a profit or a loss? You have taken long position. What is the expectation of long position? Market price will go up. Did market price go up? 9170 became 9380. Yes, profit. Selling price minus buy price. Okay, that's so you understand difference. So 10,500. So what is your margin balance now? 10,500 plus 36,680, 47,180. There is no call money because you are maintaining good amount. No worries. So this 36,6 that is 47,180 continues. No call money required. Second day, it became 9520. 9520 minus 9380. Again it went up. Long position person likes it. 9520 minus 9380 into 50. I think 7,000. So 54,180. No call money required. So 54,180 continued. So day 2 also is very happy. Market is going up. Day 3, let's understand. 9,100. Now one day market fallen suddenly. That's how market works. Market goes slowly. You feel happy and it suddenly fall down. Fast and furious. Okay, so it is down to 9,100. So 9,100 minus 9,520. Now you're expecting the market price to go up. Suddenly has fallen down. It's going to be a loss. So 9,100 minus 9,520 into 50. 21,000. See, that is the beauty of stock markets. You made how much? 10,500 you made happy. 7,000 you made profit happy. In one day, everything gone and you turned into loss, I think. 21,000 loss, market fallen. So what is the margin balance going to be? 54,180 means 33,180. Is it below maintenance margin? Oh, still is fine. 27 is maintenance margin. So no problem. So you will still continue. 33,180. Still continue, no problem. Day 4, 8960. Suddenly again you see when the market downs, it will take everything away from you. 816, 8960. 8960. Okay, so 9,100 minus, sorry, 8960. 8960 minus 9,100. Again loss, again market went down. So 8960 minus 9100 into 50, 7000 loss, plus 33,180, 26,180. Okay, now I think you have gone below 26,180. You have gone below because maintenance margin was 27,510. You have gone below maintenance margin. When you go below maintenance margin, you'll get a call from broker. Please put in call in money. How much call money you have to put in? Can you tell me? What is the shortage? How much call money should be there? Not to make it till maintenance margin. You have to go back to initial margin. So that's how this is different from minimum bank balance. There's a logic. Because if you just put the money to make it maintenance margin, tomorrow again market goes down, again he has to call you. So you have to make it till initial margin 26,180 to make it till 36,680. Difference 10,500. So you have to put in call money 10,500. That is, it becomes 36,680. It becomes 36,680. Last day, I think market recovered slightly. It became 9140. So 9140 minus 8960 into 50. I'm getting only one question. Why? Uh, I don't know. Is it because why he has to put in the full amount? As I told you, if it is just a maintenance margin, he puts it back. Tomorrow again market loss. Again he has to give a call. So he has to keep on collecting call money every time, which is not practical. And therefore, you have to put the money back to the initial margin. Until it reaches maintenance margin, broker will not bother you. Okay. So 9140 minus 8960, 180 into 50. It is 9,000. So 45,680. No margin money required. 45,680. Okay. So what they've asked, have we calculated? Mark to market cash flow and daily closing balances. We have done it. Mark to market cash flow, daily closing balance. Let me also go to one more step. They've asked net profit. Let me do it now itself. Then I'll go for the short position. Then also talk about return on investment aspect. That also you have to keep it in mind. Okay. What is overall profits? I think some of you may not be able to see right at the bottom. I'll do one thing. I'll write at the next slide. I hope you have done till here. Okay. Overall profit. Now, can I say overall profit? When I started, my account was showing 36,680. And in the end, it is showing 45,680. Can I say that that is my difference in my profit? No, that is not right. You should say closing margin minus opening margin. You have put in your own money. That has to be withdrawn, right? So overall profits equals the closing margin. That's the amount what you have got it minus opening margin. What our opening margin balance minus additional cap or minus additional capital, that is minus call money. That what you have put in. Opening money also your investment. Call money also investment. Overall profit is 45,680 minus opening margin 36,680 minus call money 10,500. Loss of 1,500. Overall loss 1,500. Okay. Actually, you don't have to do so much. You can calculate in one more easy manner. How do you calculate? Ultimately, what is the profit formula? You know, selling price minus purchase price into number of units. Whichever complicated things you learn, basic formula of profit is this only. Selling price per unit minus purchase price per unit, cost per unit multiplied by number of units. Okay, what is selling price? Last day price. Last day price is 9140. That is as good as exit price if you do square off. And your entry price is 9170. So at 9170 you purchased, future buy, 9140 you sold, future sell. So 9140 minus 9170. 9140 minus 9170 multiplied by number of units into 50. One contract only. So one contract 50 units. That also will give you minus 1,500. And my dear friends, this closing margin minus opening margin plus minus call money, have you seen anywhere in life? Maybe intermediate and all? Do you can reconnect anywhere? Can you connect somewhere? I know you would have forgotten your past life because you said, let's move on. If you remember by chance, that is how you calculate profit in single entry system, right? Single entry system. Capital comparison method, closing capital minus opening capital plus drawings minus additional capital. That is what is profit calculation anyway. So logically also you can apply, formula wise also you can apply, any basic structure also you can apply. Ultimately it will lead us to the same destination. Okay. One more thing they have not asked, but you need to keep it in mind. This has some cost. Apart from selling price minus purchase price, you will incur one more cost. Can you think what could be that one more cost? You say a borrowing cost, or you can say opportunity cost. The reason is you have deposited the 36,680, it will come back to you, no doubt. But for a period of 5 days, you lost the opportunity, right? For 5 days, you could have earned interest income. Or if you borrowed for 36,680, you have to pay interest. So it will also have either a borrowing cost or have an interest cost. Not only that, even this 10,500 also will have that cost for 1 day, for last day. So if this is practically, just keep it in mind, it will be further adjusted for cost of funds. Maybe own funds, opportunity cost, or borrowed funds, interest cost. Further, it will be adjusted. That will give you net profit. Basically, you can say money market for your reference. Further adjusted for money market if information is there. We don't have that information, so you ignore it. Some questions in foreign exchange futures, this thing will come. Okay, let's calculate a return on investment in percentage terms, just for our purpose. Actually, you lost 1,500 is the amount of loss you got, and your investment is 36,680 initial investment. Return on initial investment into 100. You lost. 40% lost. No, 4%. 4.09 minus 4.09%. So just 4% loss you are having. What about 10,500? I agree with you. But this is I just taking initial investment. What you have kept put out of your pocket from initial amount. I just put the initial investment. Technically speaking, then I should do more calculation. 36,680 is for 5 days. 10,500 is for 2 days. So I should do weighted average. Lot of things will come. So in the exam point of view also, let's do convenient. Practically it's different. Convenient answer, approximate answer, return on initial investment. Is it fine? That's why I have not taken additional investment. I have taken initial investment. This is not asked, only for your reference. But what is the stock movement? Can you see? I mean, what is the index movement? Market price movements. What is the percentage in market price movement? 9140 became 9170. Sorry, 9170 became 9140. So 9140 minus 9170 divided by 9170 into 100. P1 minus P0 by P0 into 100. Minus 0.33%, right? Minus 0.33%. You understand? Market moved just by 3.33% down, but your capital eroded by 4.09. So had you invested in spot market, of course in index you cannot do it easily, you would have lost only 0.3%, but in future you lost around 4% of your capital. That's the power of leverage. You can take more exposure. If things turn out good, you get good profit, else you lose your capital. Okay, this is not asked. I just told you only for your reference. And apart from this, you have to pay brokerage also. Brokerage on that, you have to pay GST and you have to pay STT charges, stamp duty charges. So all the transaction charges will come. Quite a few things will be there. That will also have to pay from your pocket. So those things will reduce your profit and add to your investment, brokerage and all. Anyway, so hope you got it. Okay, so this is from the point of view of person was taken a long position. Now let's go for short position. Investor who has taken short position at 9170. This should be straightforward, should not take much time. Let's do it fast. Same format I'm going to follow. So day, change in price, margin balance, call money if any, revised margin balance. Okay, let's start from day 0 and go till 5 days. 0, 1, 2, 3, 4, 5. So initial margin, he would have put same amount, 36,680. 36,680 initial margin. No call money, 36,680 will continue. Okay. Now day 1, what will happen to this balance? What do you think will happen to this balance? it's going to be loss. Market went up from 9170 to 9380. Market went up, but for him, 9170 is not a buy price. You took short position means 9170 you sell and 9380 you buy. And for a short position, you sell first, you buy later, and when the price goes up, it's against your expectation for a short, so it will be a loss. So 9170 minus 9380. 9170 minus 9380 into 50, it's going to be a loss. Same number actually, but it will be opposite. 10,500. Actually, it was plus 10,500 for long position, opposite for short position. 10,500. So it will be taken out. Remember, that was added to his account earlier. Long position, where they get money from. This fellow is taken out and put given to other person. So it will reduce now. 36,680 minus 10,500. 26,180. I hope you understand, my dear friends, why the stock exchange collects the money from buyer also, collects the money from seller also. Because if market goes up, the money will be transferred from the short to long. If the market comes down, the money will be taken out from the long and given to the short. Market is just a mediator, but it cannot wait for that event to happen. Before that only you should have the money. That's why balance is collected. That is called as margin. So stock exchange collects the margin from the buyer as well as the seller. And then depending on the market movement, it will be transferred from either person A to B or B to A. That is why margin is collected. 26,180. Has it gone below the margin money? Oh, no, 27. No problem. So this is not a problem. 26,180. Next day also loss. I think I can do fast, right? Same number. Opposed will come. I don't have to calculate every time. So I can do directly. So plus 7,000 becomes minus 7,000. Just opposite to that person. I hope I don't have to show calculation every time. 21,000 becomes profits. 7,000 becomes profits. And 9,000 becomes loss. Oh, it has gone below 27 now. Okay. Oh, 27,510. Correct. Okay. It has gone below. Correct. It has gone below the margin. So we need call money. We need call money to bring it back to 36,680. 10,500. Basically, this amount only. There is a loss you have done basically. So you have to put the money back. So it becomes 36,680. It is minus 7,000. You see, that's what happens now. Had you collected only the balance 1,000 something, again loss happened. Again you had to collect call money. Mathematically, it sounds easy. Practically, that collection becomes a tedious process. Hope you're also understanding the logical aspect. So this is 36,680 minus 7,000, 29,680. This is fine. 29,680 and plus 21,000, 50,680. Nothing. So this 50,680 plus 7,000, 57,680. Nothing. 57,680. And here minus 9,000, 47,680. Nothing here. 41,680. Oh, something wrong. 29,680, 50,680, 57,680. Oh, 57,680 minus 9,000. Oh, sorry, 48,680. 48,680. let me just calculate here itself overall profits, or I'll write separately next. Hope it is done. I'll just wait for a few seconds. I know some few people are done. I'll just wait for a couple of seconds. Okay. Overall profits. Formula, closing margin 48,680 minus opening margin 36,680 minus call money 10,500. 1,500 profit, right? 1,500 profit. And do you see, this was exactly the loss of another person who have taken long position, and that's why some people say this is also a zero sum game. One person's profit, other person's loss. But some people believe it's not a zero sum game, it's a negative sum game. Why? Because they should be further adjusted with the transaction charges, brokerage, and opportunity costs. So this should be further adjusted with cost of funds, or borrowing cost or interest, even the margin, in the brokerage, the cost of funds, all those things should be further adjusted. So when you consider, both of these people pay. And that's why some people believe in stock market, some people believe by buying you make profit. Some people believe by selling you make profit. But actually who makes profit? Brokerage. Who are the real gainers, because in both cases they earn their money. Anyway, so let's go further. Overall profit, alternatively what you can do, selling price minus buy price into number of units, that also will give you the answer. Selling price is, what is selling price for this short position, can you tell me overall? Okay, I already written also, answer is there. You sell first, you buy later. So what is going to be your sell price? 9170. Because short position, you start with sell. At what price you are going to buy? You are going to buy at 9140. So sell first at 9170 minus buy later 9140 multiplied by 50, you get 1500. What is one more way of understanding why short person is making profit, why long person is making loss? Because market went down 9170 to 9140. So when the market goes down, long person makes loss against his expectation. When the market goes down, the short position makes profit because that was his expectation, expecting the market to go down. So when the market going up, bulls make profit. But here market coming down, so bulls make loss, bears make profit. So bear people like market to come down. I know people who are bear also will go down, but bears, the animal name bear, when the market comes down, they make profit. This is what happened. Return on investment, if you want to compute return on initial investment, okay, let me be more specific. Percentage return on initial investment. Just to give you an idea. How much initial investment he had? 36,680. So 1,500 by 36,680 into 100. 1,500 by 36,680 into 100. 4.0. No, same percentage only, but profit. He had a loss. And what is market price movement? Same number. We already calculated. 9140 became 9170. 9170 became 9140. P1 minus P0. So P0, 9140 is the latest price. 9170 is the old price. So divide by 9170, P1 minus P0 into 100. We already calculate that number. Minus 0.33%. That's a beautiful thing. Market went down by minus 0.33, but you made a profit of 4.09. You can make a profit when market price goes down. You can make a profit. You can when market price goes up, but provided your expectation comes true. Hope you understand intricacies of market. You can make profit in both ways as long as your prediction becomes correct. And that is why we say you have to do analysis before investing. This is not gambling. If you close your mind and blindly you come and invest, that becomes gambling. If you do analysis, take a view, then go further, whether market goes up, comes down, take events into consideration, news into consideration, global cues, local cues, then your chances of making profit will increase. So focus on analysis, understanding the lot of data points. Okay, so many people believe in your 8 subjects, SFM is a subject which does not change. Tax changes, DT, every year once. Indirect tax, every 3-4 months, wherever GST meeting. Accounting standards, new Indies will come. People think other subjects are dynamic, but in my opinion, SFM is the most dynamic subject. It changes every day, every second. And for the tax, we have a tax act, income tax act. We have a boundary to learn. Company law boundary to learn. For SFM, there is no boundaries. Anything and everything can be made use in SFM. It's a good thing. It's a bad thing. So by learning few things, don't assume you know everything. Applicable to me also. Just because I teach you these small points does not mean I know the markets. I just understood few elements before you have understood. That is the beauty of stock market. In a way, an expert and a rookie are equal in stock markets. So anybody can come at any point in time. Okay, so let's go further on this. Hope you understood too much about stock market. I will be carried away. Okay, so let us do this problem now. Looks a very small problem. I think exam problem or RTP problem maybe. Okay, exam problem. But it will be an interesting one. Let us see. Sham buys 10,000 shares of X Limited at 25 per share and obtains a complete hedge. Complete hedge means portfolio beta, perfect hedging. Of shorting 400 Nifty at 1,100 each. He closes out the position at the closing price of the next day, where the share price of X Limited had fallen by 4% and Nifty future has dropped by 2.5%. So what is the overall profit or loss from this set of transaction? So interesting point in this problem, he has already taken hedge in Nifty. That means we don't have to tell him how many contracts to enter into, how many units to buy. We don't have to tell. They have already told. So to that extent, we need not apply the formula. Hope you're getting the point. So what I told you, in hedging, portfolio amount multiplied by beta divided by value of one contract, right? That should give you number of contracts. But we don't have to do that exercise here. They only have given. But anyway, I will do that exercise also just to tell you what would have happened had you followed differently. I'll show you that as well. Anyway, so regular format, what we are going to do, that is one column. He took a position, he closes out position, the closing price next day. Okay, so we'll write the heading as today. He has taken one set of transaction, and next day he has taken another set of transactions. Today it is position in spot markets, and today position in future market. And you know, one more could come, that is money markets. Broad structure, be very clear about the tabular format. You will be able to solve the problem in a systematic manner. Okay. Buys 10,000 shares of X Limited at 25 per share. So X Limited investments 10,000 shares of 25 each. That is 2,50,000, I think. And this is what he buys. So which position? That is long position. Long position. Okay. Then futures, index futures, Nifty future, we were supposed to calculate, but they only have given. They have shorted 400 Nifty at 1,100 each. So Nifty futures, (400 units of 1,100 each. 400 into 1,100. 4,40,000 short. They only have given. So up to this point, we have not done any calculations. Whatever data they have given, we have put it in a structured format. Then what is the change that have happened? Change in percentage terms. They said next day, share of X Limited fallen by 4%. X Limited fallen down by 4%. And Nifty future dropped by 2.5%. Nifty future dropped by 2.5%. Okay, now let's see what really happened. Impact. Next day, what is the impact, or what is the profit or loss? 2,50,000, 4%. How much is going to be the amount? 10,000. Now, profit or loss? What do you think? In X Limited, you had taken a long position. That means taking a opinion market price would increase, but it has fallen. So that is going to be loss. Long position is normal position. Going up is profit, coming down is loss. In short position, it is down by 2.5%. So 4,40,000 into 2.5%. 11,000. Okay, so now you tell me 11,000 means profit or loss. You are taken in Nifty future a short position expecting market price could go down, but market price did go down. In line your expectations, profit. This is abnormal situation for you to remember, because a short position means reverse. Market goes down, you make profit. Okay, so overall, I think you are having a profit of 1,000. From exam point of view, the answer is over. Simple, beautiful, tabular format presentation. Anybody can understand what position you have taken, what is the change, what is the impact, and overall impact. Sufficient from exam point of view. Now let's do our analysis. But before that, see if you have done till here, and if you have any question, please ask. Okay, done. Very good. Now let us do some analysis. They said complete hedge, right? Complete hedge means what? Complete hedge means perfect hedge. And what is perfect hedge will result in? What will be the beta of portfolio after doing perfect hedge? Whatever be the beta, whatever may be the risk, but after doing a perfect hedge, beta of portfolio target, it should become zero. Beta of portfolio should become zero. That is called perfect hedging. But I also told you it has some practical limitations. Why perfect hedging may not be achieved? Practical limitations for two reasons. One, the lot size. Correct, remember, because of the lot size, number of contracts may need to be rounded off. In this problem, we don't know the lot size and all. In this problem, lot size cannot be the reason because we don't have lot size. Let's forget about the lot size. Let's say one contract, 1 unit or something. That does not have lot size. Then what is the other situation? Beta holding good. Beta is a historical measure, statistical measure based on the past share price. Now, does it apply on a daily basis? Answer is no. So, beta and all gives you an indicator what is likely to happen. And in exam point of view, if nothing is given, we assume that okay, this is what has happened or what is likely to happen in case not given in the problem. In this problem, they have not mentioned about the beta, but we have to analyze that aspect. They have not mentioned anything about the beta at all, but we have to analyze. But you understand, they would have used beta, just that we did not observe. Why we did not observe? Look at the amount of position. Spot market had 2,50,000. Future market had 4,40,000. We have taken more position. That means beta must be there. Beta must have been multiplied, right? So what is the thing if you remember? I'll just rewrite the same thing. Spot future. What must have been the beta? I'm trying to tell you. So before taking a position, or the position in futures, position in index futures would be how it is calculated amount wise, portfolio amount multiplied by beta. Position in index futures is 4,40,000. Portfolio amount, X limited investment 2,50,000. portfolio beta. That is, we need to calculate. So if we calculate portfolio beta or beta of security, only one security is there. 4,40,000 divided by 2,50,000. 1.76, right? 1.76. This must have been the beta. But now the question is, did the beta hold good or not? Answer is no. Let's check it out. What happened to the market? Nifty has fallen by 2.5%. Okay, now tell me, had Nifty fallen by 2.5%, what would be the portfolio should be fallen by, or the shares of X Limited should be fallen by how much percent? Don't take 4%. 4% is given, but if you apply beta, 2.5% into 1.76, right? That's beta times. From the market to come to beta, you multiply. So into 2.5, you get 4.4%. That was supposed to happen. This was supposed to happen if beta holds good. If uh, market moved as per beta, that is, if beta holds good. If beta holds good. In the sense, if movement happened as per expectations. Now, what would have happened in this case? In spot markets, in future markets, in spot market, sorry, in the spot, I should write future here, not there. Okay, heading I'll not write it now. I'll write it now here. Spot. Sorry, heading is today and next day. Portfolio, index futures, portfolio amount. We don't have to calculate every time. 2,50,000, and index future 4,40,000. And what is the change happened? Index future 2.5% down, but because short position, one short negative, 2.5% also negative. So you can say mathematically also like that. Short position means negative, 2.5% down means negative, so double negative. You get a profit of 11,000. Now to 2,50,000, if this was down as per beta 4.4%, how much loss you would have made? Down by 4.4% as per beta, how much loss you would have made? 2,50,000 into 4.4%. You would have got 11,000 profit, 11,000 loss, right? And you would have got absolutely zero impact as per expectations. But beta did not hold good. This did not happen to be 4.4%. This happened to be only 4%. It was supposed to be down by 4.4%. It did not fall so much. It just fallen only 4% and gave you a loss of only 10,000. It was supposed to give me 11,000 loss. It gave me only 10,000 loss. That is why you make overall 1,000 profit. It could have been loss also. It's just that as per beta movement, the portfolio did not move so much. I hope you understood why it did not move so much, and practically beta will not apply on everyday basis. It is just an indicator as to whether it's a risky stock or not a risky stock. Okay, this analysis not required for exam. I just did for your reference so that you understand the hedging also from a practical perspective. That is why something happened to be profit or something happened to be loss, even though we say a complete hedge. So this was 11,000 loss expected as per beta, and this was actual. Now, I should not make an argument, right? If actual does not happen, then why beta is there? We should always make an expectation because future is always uncertain. Just because uncertain does not mean you don't do anything today. We have to make a decision based on average, right? That average is beta. Someday it may take more time when you travel from home to office. Someday it might less time. You should go on average. Sometime your average will be broken. You end up in going late, or sometimes average may be earlier. You end up in going early. So things are always going to be fluctuating, but we still make good decisions based on historical average. I hope you're trying to connect what I told you on day one. Ultimately, this subject is about making better decisions based on past. Okay, let's go further. Okay, good. This is January 2021, old syllabus question, but applicable for new syllabus also. I hope you got this question. This was the first time this kind of question was asked. But good problem to understand the stock lending mechanism, especially shorting concept. Hope you got the question. Mr. A is holding 1000 shares of face value of 100 each of Messrs. ABC Limited. He wants to hold these shares for long term and have no intention to sell. That means he is taking long position. He is holder. He is not having any intention to sell. We have to find such kind of people only to borrow who holds, because anyway they will just be keeping quiet. You can borrow from such people if your intention is opposite. On 1st January 2020, Messrs. XYZ Limited has made a short sales of ABC Limited shares and approached Mr. A, please give, to lend his shares under stock lending mechanism with the following terms. Sir, is it so easy to borrow the shares practically? For institutions, yes, because lot of deposit will be there, lot of rules will be applicable, lot of contract to be signed. So lot of legal aspects are there. So and minimum contract value and all will be there. So practically for institutions it is possible, but individuals we don't do stock lending mechanism. If you want to short, there are other mechanisms. We'll discuss later. What are the stock lending mechanism with the following terms? Shares to be borrowed for 3 months. Remember tabular format, today, later. Today will be 1st of Jan and later will be 3 months. Lending charges. Fees of 1% to be paid every month on the closing price of the stock quoted in stock exchange. Okay, usually we ignore the transaction charges. Here we have the transaction charge. Bank guarantee will be provided as collateral for the value. Okay, because default will be there, some sort of guarantee will be given. That will be there in borrowing of money also. Cost of the bank guarantee is 8% per annum. On 29th February, ABC Limited shares quoted, still 1 month is there, in stock exchange on the various dates are as follows: 1st Jan, 31st Jan, 29th February, 31st March. Share price in scenario 1 bullish, price increased. Share price in scenario 2 bearish, market price reduced. Okay. You are required to find out earning of Mr. A. Who is A here? He is the lender, not the borrower. Lender. Through stock lending in both the scenarios. Total earnings of Mr. A during 1st Jan to 31st March in both the scenarios. Same question. Earnings of A and total earnings of A. Okay. what is the profit or loss to Mr. XYZ by shorting the shares using stock through like a mechanism, both scenarios. So we are discussing basically from both the parties, from A's point of view, from as well as from XYZ point of view. Read the question for 1 more minute. So in the table, both are mentioned as bullish, is it? Okay. The second one is actually bearish. Okay, that's what institute has given. I copy pasted actually. But anyway, does not matter. The name does not matter. But you understand, price is falling. So that might be typing mistake in the exam question also. I don't know. But that does not matter. Anyway, the price are falling here. You understand. Substance over form, it is down. Okay. First part of the question they have asked, through stock lending scheme, earnings of Mr. A through stock lending scheme. Earnings of Mr. A through stock lending scheme. Only that means charges what they do, stock lending scheme. So we're not talking about shares profit and all. What is that charges he is doing? Lending fee, lending charges, fees. I told you it's not an income, it's not an interest. Say income, but not an interest. 1% on every month on closing price. So what is every month? Jan, Feb, March. 1% on these numbers multiplied by number of shares, 1000 shares. So let's do in a columnar format. Scenario 1. Scenario 2. This is the income that the borrower should pay to the lender, because not because of value change, but because risk of default is there. For that commission service. Okay, so 3 dates or 2 dates. Okay, month end. 31st of Jan, what happened? That monthly have to be paid. So 31st of Jan 2020, that month what we have to pay. Then 29th Feb 2020, what you have to pay. Then 31st of March 2020, what you have to pay. Very simple concept. Number of shares, thousands. Market price. What is market price? 1020. Fees 1%. Very simple. So 1000 into 1020 into 1%. How much you get? 10,200. Right? Okay. Or let's do one thing. I'll compute per share. Then I'll multiply it by thousands. You can do both ways. Do we require per share basis? Anyway, I think I'll compute just per share basis. Then at the end, I'll multiply it by 1000. I think I get 10.2. Okay, 10.2. I'll just compute per share. Then I'll multiply it by number of shares. 10.2. Then 1040, 1050. 1040, 1050 into 1%. I think I get 10.4 into 1%, we get 10.5. So total for 3 months, 10.2 plus 10.4 plus 10.5, 31.1 per share basis. This is per share. Then total income multiplied by 1000 shares, 31,100. Scenario 1. Scenario 2, we'll do it quickly. 980, 960, 940. 980, 960, 940. Simple one, so I'm doing it fast. Looks complicated, but within your control. Into 1%, into 1%, into 1%. Think 9.8, 9.6, 9.4. So total 9.8, 9.6, 9.4, 28.8 per share multiplied by 1000, 28,800. This is if the share price goes down. Another scenario. Okay. Hope it is done. Let's go to second part of the question. Total earnings of Mr. A during these three and both scenarios. Total earnings means this whatever the fees collected. Apart from that, what else he gets? Can you tell me what else he should get? Is there any dividend information? No information dividends. Just 1 second. Oh, I think dividend information is not given, but in the uh, lending fees, shares to be borrowed, bank guarantee, cost of bank guarantee, earnings, total earnings, what is the profit or loss? No information on dividends, but because in the solution they have used, I'm just thinking whether anywhere in the question it is there. I think it might be missing, right, in the question. Okay, I think the question has not given a missing, but in solution they have taken. So I'll just add in the question. That might be a typing mistake. Just consider dividend income of 25 per share. Just add it to the question. Dividends per share 25. Just add to the question. Paid during this month. Paid during this period. Paid during this borrowing term. Paid during this period. Dividend per share. So if I take this dividend per share of 25, what would happen? Total earnings of Mr. A through stock lending mechanism. Okay, that's what they are specifying in both scenarios. Scenario 1, scenario 2. Dividend income, I just told you. Dividend income 25 per share, okay, 25 per share, I told you. And stock lending income, that is charges you collected, 31.1, 28.8. So what will be that number coming to? 56.1, 25 plus 28.8, 53.8. This is per share. Multiplied by thousands. 56 100, 53 800. Just 1 second. Okay, this is the income part. They have not asked what is the impact on share value. They have not asked in the problem, but let me calculate. Impact on investment position. Impact on investment position. What value you are purchasing when you were lending, it was 1000 rupees. At the end, it became 1050 and 940. That is your portfolio appreciation and portfolio loss. So portfolio appreciation or depreciation. This will not be compensated. This will not be compensated, or this will not be shared. This is your profit or loss. You would have got it anyway, even if you're not done stock lending. So 1000 rupee became 1050, 940. 1050 minus 1000. Here you get 50 per share. Here 940 minus 1000. You get loss 60 per share. If you multiply it by thousands, you get 50,000. You multiply it by thousands, you get minus 60,000 loss. This loss or profit, this portion, okay, last portion, they have not asked in the exams because this would have happened even without lending mechanism. Even if the stock lending did not happen, you still would have gained 850,000, you still would have lost 60,000. So that's why this portion is not asked, but I have written for your reference. Hope you understand my handwriting. Impact on investment position, portfolio appreciation or depreciation, 1050 minus 1000, because 1000 became 1050 at the end of 31st of March. 50,000 profit, similarly 60,000 loss. Okay, let's go to the next last part of the question. Hope you have done here. What is the profit or loss to XYZ by shorting the shares? Who is the borrower? Profit or loss to XYZ? Who is a borrower? So what and all is going to be borrower profit or loss? Remember what and all we are going to consider? Again, scenario 1, scenario 2. The difference in share price, that is going to be a profit or loss. That is a price difference. And you paid some lending charges. Stock lending charges you paid. Stock lending charges you paid. And then you also paid some bank guarantee. Bank guarantee you paid. And then a dividend. Dividend is also a compensation paid. But I'll show it separately. But it also will come. Dividend paid as compensation. I'll just show both before dividend, after dividend, what will happen. Dividend paid as compensation. Because he has to receive means you have to pay, obviously. Unless the dividend is coming after the 31st of March. Anyway. So what is the price differential? Only the closing price. In fact, we already done, right? I'll use that number only, or I'll calculate. At 1,000 rupees you sold, and 1,050 rupees on 31st of March you purchased. So 1,000 into 1,050 into 1,000 shares, I'll take it, let's say. That is minus 50,000, I think. Loss for you. And lending charges paid. We already calculated. First part, I'll use that number only. 31,100. Income for him, payment for you. So minus 31,100. Bank guarantee also you paid. How much bank guarantee? 8% per annum. On what guarantee? Amount of borrowing. What is amount of borrowing? The rate at which you have shorted 1,000 shares of 100 each. So 1,000 shares of 100 each into 8% for 3 months. This is also your payment, okay? How much this will be? 1,000 into 100 into 8% for 3 months. 2,000. 2,000. That is also payment. So minus 2,000. Dividend compensation 25. 25 into 10. That I'll just do a subtotal before that. I'll just do dividend compensation also. Dividend is 25. 25,000 then. 25 into 1,000. 25,000. So let me do a subtotal of this and then total of this. 50,000 payment. 31,100 payment. 2,000 payment. 25,000 also payment. Not income, payment. So this is 83,100, I think you get. And if you do this total also, then you get 1,08,100. 1 second. Is the calculation correct? 50, 31.1. Oh, just compute the bank guarantee. Oh, bank guarantee is on face value, is it? No, sorry. I think I took market price. Sorry, not face value. My mistake. Sorry, my mistake. Not on 100. I took face value by mistake. It should be market price, 1000 rupees, no? It was 1000 rupees, right? It was trading on that day at 1000 rupees. On the date, it was 1000 rupees. So it should not be on 1000, not on face value. It should be on the amount of borrowing, not on the face value. So it's not on the, sorry, my mistake, not on 100, make it as 1000. Make it as 1000. I think you get 20,000 then. So this number will change. 50,000 plus 31,100 plus 20,000. 1,01,000 here. And with the dividend, if you consider 1,26,000, right? 1,26,000. And scenario 2, prices come down. So you're going to make a profit then. It has come to 940. So 1000 minus 940, right? 940. 1000 minus 940 into thousands. So 60 into 1000. 1,26,000, 100. Huh? Oh, sorry. Okay, 100. So 1,01,100 this and 1,26,000, 100. Okay, corrected. So this is 60,000 profit. Stock lending charges same only? No, different. We calculated 28,800. 28,800 outflow. Bank guarantee amount is same, 20,000, and dividend paid is same, 25,000. So let's see what is the amount. So 60,000 minus 28,800 minus 24,000 to 20,000. Uh, 11,200. Okay, 11,200 and minus 25,000 minus 13,000. Yes. So hope you understand. In the first situation, market price went up against the expectation of the lender, against the expectation of the investor, because shorting means you're expecting price to come down. So in first situation, it went against. That's why loss. Whereas in second situation, it was as per your expectation, market fell down, you make profit. But because of charges, ultimately still you're having loss. Whereas in the investor A point of view, he's a holder. Basically, he's taking long position. So when bullish happened, market price increased, he made a profit. But when the market price come down, he made a loss. Opposite for the borrower, opposite for the person who's taking short. Hope you understood the position from long and short with the help of this problem. First time, at least I've seen, stock lending mechanism is being asked in exams. Okay, is it done? But somehow institute, the one thing is surprising me, I'll just tell you institute solution. I told you this dividend per share, right? I made you to add. This was not given in the question. I don't know if it is a printing mistake. But they have taken this in the Mr. A and they have not taken it in the XYZ point of view. So I see some conflict in the institute solution. Dividend they have not given in the question. But for A they have taken, XYZ they have not taken. According to me, that is not right. Because if dividend is there, for A it is income, for XYZ it is payment. For A it is inflow, for XYZ it is outflow. That we discussed. If dividend is not there, both of them should not be there. Yes, if you interpret after 31st of March, I agree with your point. If dividend is paid after 31st of March, it's only income for A, it will not be for XYZ. But the question what they said, total earning during 31st of March, 1st of Jan to 31st of March, right? If dividend is after 31st of March, then that should not come here. So somewhere something is not right. Maybe typing mistake, I'm not sure. But anyway, we have done dividend is there. For A, we have taken as income. For XYZ, we have taken it as outflow. So our answer is completely fine. logically. So you should be clear. You should be clear about it. Okay. Uh, this is stock lending mechanism. Hope you understood the concept. How come dividend would be a loss to the borrower? We have written a sentence also, right? Anyway, I'll explain once more. Borrower borrowed the shares and he sold it also. So he is not the owner. So he will not receive dividends. He is not receive dividends. No, he is not getting paid. He is not receiving the dividends. That is why I am telling. He borrowed the shares and he sold the share in the market. So he does not hold it. So he is not receiving any income. But the lender, if he was continues to be the shareholder, he would have received dividend. He lost it because you borrowed. You are not receiving that income. So it is this your responsibility that you pay dividend as a compensation to the lender because he has lost the opportunity. But you are paying. You are not receiving from anybody. You are not the holder. You are already sold the shares. So you don't hold the shares. So you have to make the payment to him. Everything will have a cost, right? When you borrow, interest was a cost. When you borrow in shares, dividend is a cost. That's why balance sheet approach. Long position, you borrow money, you pay interest as a cost. Short position, you borrow shares, you pay dividend as a cost. I hope you got the concept, but that is a critical concept. You have to remember it very clearly. In this case, he has to give back to A. Yes, he has to not give back, he has to pay to A. He is not receiving from anybody, but he has to make the payment. Because you borrowed the shares had an income of dividend, you are not receiving it, but you have to make the compensation. You are not receiving, but you have to pay. So that's why for Mr. XYZ, it is an outflow. For A, it is an income. Got it right? Clear? Okay, but that point is very important. In case of short position, dividend payment will be an outflow. The one to XYZ lent, they will receive dividend. Yes, the one who lent to XYZ, who lent to XYZ? A only, right? A only lent to XYZ, or A is receiving from XYZ. Now, who will receive the dividend actually? Who will receive the dividend? XYZ would have sold to somebody. No, whoever that person would have received dividend. Or if I tell you one more way, if you understand me right, I'll just say last point. Let's see if you're able to understand. Yes, XYZ would have paid to some person. XYZ would have sold to some person and he received the money. That person received dividend. But you know what is the concept? Come dividend price, you know. When you are selling the share, that share price will include the dividend component. Are you understanding? XYZ, when you sell the shares, that is come dividend, right? Includes the dividend component. So when you receive the money, how much? 1,000 rupees. That would have include dividend component. So indirectly, he has already received and the person is already paid and he will recover. The buyer for whom XYZ sold, the third party, he will recover the cost from the company, thereby the dividend component is recovered. But this 1,000 rupees includes dividend, come dividend, and this amount you are paying to the Mr. A because it belongs to him ultimately. So recovering from him, final consumer finally applies. Yes, exactly. That's what I told you. The third party, when he pays the money to XYZ, he would have paid including dividend, that 1,000 rupees. So when the third party receives dividend, for him it will be a recovery of cost. Would Mr. A get the shares or money at the end of 3 months? At the end of 3 months, he get back the shares or he get back the money equivalent to get the shares. Ultimately, he get the shares. So at the end of 3 months, he get the shares or he will be given the money to buy the share at that point in time. Ultimately, he will get the shares. You get the product or I'll pay you the money to get the product. Ultimately, you will have the product with you. Hope you are clear. I repeat this point once more. What to be kept in mind ultimately? In long position, dividend income. In short position, dividend payment. So for solving problem, that's all the concept. Okay, I hope things are clear. Very good.